The wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
If you're in a board meeting or something like that, does your assistant tell you that there's a call from the Secretary Treasury or Chairman of the Federal Reserve, where they put that right through, or do you say, I'll get back to them when
My chairman sitting in front of me here, you can attest that I will dump the board to pick up Janet Yellen or Jay Powell.
This year has all been about the whipsaw.
We don't think rates are going to continue to fall right here. We think we're going to see them turn around.
We're not in that camp that we're expecting the Fed to turn so quickly.
I think the market is possibly getting ahead of itself in terms of pricing cuts. Could there be rate cuts coming in 2024? Sure, right? But we think there's going to be one more hike this summer.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The new guy, UBS, is the old guy. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Equity futures doing okay this Wednesday morning, up by almost 0.9% on the S&P 500. TK Sergio Amotti is back.
There was, and you and I felt the same way. We saw the headline as we were greeting the morning, and we're like, why did we think of that 5 days ago? It's so obvious, and what's particularly important for me here, as we mentioned in the last hour, Sean Patrick Barnett there with great coverage from Frankfurt. This is cultural, and it's domestic. Yes, it's about wealth management. Yes, it's about IB. Forget about it. It's about a nation livid. They went with the boy from Ticino.
And they've gone for the guy from Lugano, as you said it, the Swiss man.
Do you
is
like how I
back.
pronounce that?
I like that. You
Zoe
practiced that this morning.
No,
Nice.
no.
Did you make the calls to
Zoe
Switzerland?
Schneeweiss from Zurich. I said, Zoe, help me here. How do you is it Ticino, whatever?
Well, it's not just that he's Swiss, Lisa. As Tom pointed out, he's got experience running UBS, and he's got experience winding down investment banks and making them smaller.
And he's got experience with a lot of legal problems because there were a lot of legal problems along the way in the post-crisis era, and he's going to be dealing with them on all sides of the Atlantic, as we learned this morning from the U.S., coming out with some scathing allegations about tax evasion for UBS, not out of the woods, and yet now they have somebody with ample experience and a backstop from the Swiss government to handle it.
You can't escape the trouble even though the entity's been taken over. Seemingly the headlines just keep coming, the hits keep coming. Lisa, the headline from the U.S. Senate panel about 30 minutes ago, if you are just tuning in, Lisa reads as follows: Credit Suisse is still aiding tax evasion. That's the allegation.
And UBS has to stomach it because they're assuming a Credit Suisse and all of their obligations. Again, though, ultimately, to your point, John, and it's a really good point, won't the Swiss government ultimately be basically backstopping any fine they have to pay the U.S.?
It depends how big it is, if it's big enough, because I know there's some tearing here about when the state guarantee kicks in. But ultimately, if it's big enough, Tom, it's a sovereign wealth transfer, isn't it? Aren't they on the hook for this stuff?
I'm not going to get myself in trouble there, but I am going to agree with you. There's a tiered agreement here, but I'm not sure we know those details. The one number I've seen, and please, folks, don't quote me on this, 170 billion seems to be what the people of Switzerland are into. for the collapse of 3 big banks going back 30 years, then 2 big banks going back 30 years. This model's working out.
Nice.
And then 1 big bank going back 30 years, and it's 170 billion large is one statistic.
So this was 2 weekends ago. The weekend before that, the US had its own troubles. We heard from the Vice Chair of Supervision of the Federal Reserve yesterday in front of the Senate. We hear from him in front of the House a little bit later. Lisa, based on what you heard yesterday, what do you want to hear today?
Do they back what Wendy Schiller was just saying? Is this basically a time to emphasize the big banks and say that regional banks really either need much stricter oversight, higher fees, or need to be consolidated and made bigger? I mean, ultimately, isn't that the conclusion that we've gotten?
More regulation? Not just that. Where was the enforcement? Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
That's the key question.
And this is my problem right now. When we talk about more regulation, they had oversight. They knew there were problems. There were obvious problems that were flagged. Michael Barr said that he was aware of them as early as February, and probably earlier than that. So at a certain point, what are we talking about here? And I think that you raised that well.
John and I have had a beverage of our choice, very expensive, at the bottom of St. James Street in London. And there's a statue out on the street of a guy who said, overcome by events. They were overcome. All of what you guys just said is true, and John, you nailed it with the idea, why didn't they do something? It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Do you think it's unfortunate that the Vice Chair of Supervision, Michael Barr, is the guy that's taken the heat from this, Lisa, and not the former guy, and I'd go one step further, not the current guy, the Chair of the Federal Reserve as well?
I would strongly agree that I want to hear from Randy Quarles. I want to understand what was happening with him with respect to how some of the regulations were loosened or whether enforcement was de-emphasized. That's really what I want to understand, perhaps more than Michael Barr.
And the Fed Chair?
Who is also overseeing a lot of that. Yes, that's correct. And I think that that's the reason why people are pointing fingers at the Federal Reserve and questioning what this impact will be on the credibility of an agency that's tasked with a very difficult decision right now.
Here's the price action in the moment, up 0.9 of 1% on the S&P 500. In the bond market, yields lower by a couple of basis points. Let's call this 355 on a 10-year. On a 2-year, Tom, let's call it 4%. We're down about 4 or 5 basis points at the front end.
My single data point, John's got to be where we've been the last 3 days, where you were interviewing with the Tots for the coaching job, and that's 4.03% 2-year. We really haven't had that 2-year breakout to a new higher yield regime from the shock of 3.76%.
Can you imagine if I left to run a football club, Tom? How would you feel about that, really?
I'd grow my beard and be standing right next to you there going, oh!
That moment that, like Nate.
Do you like Ted Lasso, the new season?
I haven't started watching it yet. Is it good?
By consensus among people smarter than me, the last episode was the single best episode ever.
So Nate is at West Ham, is that right?
Do you know who's joining the squad?
At West Ham? Who's joining?
Nate's at West Ham, but he's out of the plot. Who's joining is, I think it's Zava, who's patterned after the guy at AC Milan, Ibrahimovic.
Ibra, yeah.
Ibra was in the show last week as a new guy, a fictional guy,
really?
Who's joining, who's a prima donna.
And he's older?
He's older, and he's old. That's the plot going forward.
So now AC Milan is basically Richmond FC.
Yeah, but finally you'll get into it because AC Milan shows up to save the day.
Lisa, we'll pick up on that over the weekend, I guess.
I have no idea what you guys were just talking about. 100%. 10 a.m. I'll tell you what I'm looking at right now. At 10 a.m. we get day 2 of the hearings in Washington, D.C. Fed and Treasury officials are testifying again before a House committee about Silicon Valley Bank. We're going to hear from Michael Barr, the current head of the Vice Chair for Supervision for the Federal Reserve, Martin Grunberg of the FDIC, and Nellie Liang of the U.S. Treasury Department. Do they come out with some sort of prescription for how they should oversee this? Do they talk about the importance of banks getting bigger? The irony, more than a decade after the financial crisis, of looking to make banks bigger. 10 a.m. we also get pending home sales. The data points that maybe don't matter. I think this does matter because when you start to see rates coming in, people buying bonds, there is this question of, okay, that brings down mortgage rates. Game on. Everybody go back to the market. Is that what we're going to see in a plateauing of some of the declines in prices and some of the gains that we're seeing in the number of sales?
And Lisa, great chart you selected there. For those of you on radio, basically it's the crater of year-over-year real estate. Lisa, I think a lot of people aren't aware we've come near the zero bound on year-over-year gain.
And yes, that is absolutely true. And now the question is, what from here? I mean, how much more pain is there? And perhaps we'll hear some of that today. Speakers at the National Association for the Business Economics unit over in Washington, D.C., are incredible. It is an incredible lineup. Rich Clarida, the former Fed Vice Chair, as well as Catherine Mann of the Bank of England, Seth Carpenter of Morgan Stanley, Tobias Adrian, Isabel Schnabel. Incredible lineup at a time when so many people have a very unclear sense of both Fed policy, ECB policy, as well as the path for inflation, John.
Bravo, thanks for that. Looking forward to those speakers through today. I understand Mike McKee's going to make it down there at some point as well, so we get some reporting from him too. Joining us now is Linda Dossel, the Senior VP and Senior Equity Strategist at Federated Hermes. Linda, I want to start with this. What is special about 4,000 points on the S&P 500? And what do you make of this struggle since November to break out more than 5% in either direction, up or down?
Well, good morning. Thanks for having me. I would say that 4,000 S&P is not nearly as important psychological numbers, maybe 30,000 Dow has been historically. I think we've gotten past that. Well, what we haven't gotten past is technicals, and technicians are really over, they're on top of all this stuff all the time. And I keep reading about the technical levels through which the S&P needs to pass, as you suggested, a very tight range for quite some time. I think it's something like I think it's where we open now, 46 or 40, 36, 40, 40, something like that. We're at the high end of what has been a tight range. The 200-day moving average is something that is watched very, very closely. And that's not just for the market, but for individual names and sectors to let us know. I think technicals and technicians are very much involved these days. It's not so much a psychological number anymore, but a level. 200-day moving average, big one. 50-day moving average.
Linda, there's such respect for the long-term view of Federated Hermes, and I want to go back to something I haven't looked at in ages, which is the market drawdown from the peak of what seems ages ago. I was shocked, Linda. I didn't know this. Standard & Poor's negative 70%, down negative 11%, NASDAQ negative 24%. On the day-to-day grind at Federated, are we still in a bear market? And how are you positioning given the duration of this bear market?
Well, we are still in a bear market, and it's gone on for quite a long time, but we are now in a range-bound area. And it sounds so boring to continue to say that we're in a neutral space right now. So we'd like to get up over the old highs, and we think it's going to be a number of years delayed because of the pickle that we find ourselves in now, that the Fed got in the way and they started to raise rates dramatically. And when they raised rates dramatically, then that messed something out over in the banking area. And that's what happens when you rock the boat as much as what we have. So we still do remain mired in this bear market. And all we've seen last year was a 25% pullback, which is garden variety. And so we're wondering if maybe we deserve more than that with the mess that we're in right now.
Does it make sense to you, Linda, that we've seen this incredible rally in bonds and in stocks, that people are pricing in fewer rate hikes and possibly rate cuts, and they're also pricing in a very strong economy?
Well, I think it goes to something that you were saying probably just a few moments ago, which is that if the market itself doesn't look like it's getting hit that hard, you're having rolling recessions underneath, and there's still so very, very much liquidity out there, not just with traders, but also with individual investors that aren't married to anything right now. And they say, well, I see that they crushed tech stocks. Let's go run after tech stocks. And right now they seem to have run after tech stocks. And so in recent days, we've hit energy hard. Let's go run after energy. So what did we do last year? We hit stocks and bonds. And so let's go ahead and run after them both, because we have, last number I saw, almost $2 trillion of cash on the sidelines. We prepared for the recession. It's just not here yet.
Linda, have you ever gone for a drink with Lisa? I think you'd both have a great time.
I think so. I love that. That was so much fun.
Linda Dossel there of Federated Hermes. Bramo, you talked about the wisdom of crowds last week, or lack thereof. I think Linda's speaking to some of that right there.
I love it. Just basically, I picture, little cartoon characters running after each sector, like, no one's gotten those for a while. Let's go over here. That's sort of what it feels like, a rolling ball of money kind of just going into different sectors.
But in the literature, you have rotation. But I don't understand how you have rotation given the broad dynamics of the fixed income market now. It's just too unstable.
I think that word rotation, Tom, is kind of the sophisticated way of making it sound,
It's like the washing machine when you're surfing and you get just basically sucked into the waves.
You can't do that where the move index is.
We're rotating.
Again,
it makes it sound sensible, doesn't it? Like, there's real purpose and reason behind a lot of it.
Well, that's a different story.
Lee Ferridge of State Street in the next hour. Looking forward to that. Equities up 0.8%. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Swiss banker Sergio Amotti is returning to the role he had for 9 years. Amotti will once again be CEO of UBS to oversee that complicated acquisition of Credit Suisse. He is replacing Ralph Hamers, who's been CEO for just over 2 years. Amotti will take over after next week's annual general meeting. Hamers will stay at UBS for the transition period. Meanwhile, a U.S. Senate committee says that Credit Suisse is still helping rich Americans hide assets from the IRS. That's almost a decade after one of the bank's units pleaded guilty to tax evasion conspiracy. According to a new report, Credit Suisse worked with dual citizens to conceal assets from tax authorities. The bank says it does not tolerate tax evasion. Now, Ukraine's President Volodymyr Zelensky is warning that a Russian victory in the city of Bakhmut could be perilous. He told the Associated Press that Moscow could then build international support for a deal that would force Ukraine to make unacceptable compromises. Zelensky has also invited China's President Xi Jinping to visit, despite China's ties with Russia. Now, the CEO of Macy's, Jeff Gennett, will retire in February after 7 years of leading the department store. He'll be succeeded by Tony Spring, who serves as the president of Macy's and CEO of the company's high-end Bloomingdale's chain. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Leanne Gerrans, and this is Bloomberg. In Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make a decision.
UBS has named interim chief executive Sergio Amotti to take the job permanently.
Sergio Amotti has got to do 3 big things. He's got to convince the shareholders that he's got to control risk. He's got a grasp of what's going on in the investment bank. He's got to bolster wealth management and reduce leverage.
Bloomberg's been speaking to the new boss of UBS, Sergio Amotti.
Sergio, great to have you with us today on Bloomberg. Sergio Amotti, welcome to Bloomberg, sir. The best quarterly profits since 2010. On each occasion when we've sat down with Sergio Amotti, he's had a great numbers story to tell. You're 3 years into this. Give yourself a mark out of 10. How have you done?
It's Christmas time, so I'm gonna be very generous with myself. So I give a lucky number, 8.
Orchel is gone. Zeldner is gone. Are you all in and committed to this bank going forward? What do you want to say to the market today?
Well, of course, I'm committed.
Sergio Amotti, welcome to Bloomberg. Your final set of results after 9 years at UBS.
Just amazing, fantastic work.
That was
from our colleagues in London.
Was the
wasn't
guy
it great?
In the middle of it? He looked like Guy Johnson.
Guy
but
Johnson,
I wasn't sure that was.
Francine Lacqua, Manus Cranny.
My word, well
fantastic
done.
work
Really
covering
good.
Sergio Amotti for the best part of a decade. And the news this morning, if you are just tuning in, Amotti is back at UBS, Tom, taking a helm of the combined entity of UBS and Credit Suisse. What a turnaround.
And that is a span of a turnaround. When this bank, UBS, Union Bank of Switzerland, SBC and Union Bank of Switzerland, bailed out by the Swiss government in 2008, and Amotti parachutes in, I'm going to guess 2-3 years after that, and that's where you begin to see the Bloomberg coverage of this guy that came from Merrill, then from UniCredit, and over to the GFC post-UBS.
The understanding that sort of is implied in all of those years, and the oldness of the 2011 videos, which is sort of shocking because it wasn't that long ago, but this question of the historical institutional knowledge of managing through a crisis and managing different cultures, and that, I think, really is highlighted by this person.
UBS right now is up by about 2%. We'll cover that story for you through the whole of today on Bloomberg TV and on Bloomberg Radio. Equity futures positive by about 0.8% on the S&P 500. That's the Swiss story of this morning. We have to deal with the US banking story as well. US regulators, including the US Vice Chair of Supervision of the Federal Reserve, Mr. Barr, Tom, in front of the Senate yesterday, in front of the House a little bit later.
Yes, the hearings there are tangible, but now overlaid by what we saw this morning from the gentleman from Oregon, Wyden. I mean, this thing is an overlay. How do you avoid that at these hearings today?
Pretty tense stuff, Tom, to read that headline, that the committee's investigation uncovered major violations of a plea agreement made back in 2014.
Bunch of distractions in Washington. Let's get to it. She is with Balance of Power. And, of course, our chief Washington correspondent, Amory Horton, joins us this morning. Amory, is there any implication or linkage of these hearings into the Wyden release this morning? I was stunned by the fiery language in that release.
It was fiery language, and if I could just bring you some of it, he calls them greedy Swiss bankers, quote, who appear to be engaged in, this is the quote, massive ongoing conspiracy to help ultra-wealthy U.S. citizens to evade taxes and rip off their fellow Americans. I mean, at some point, potentially, this can be brought up in the hearings today. But, of course, these hearings are about the collapse of 3 U.S. mid-sized banks, and they're going to be asking the regulators what happened. Yesterday, it was clear from the regulators, especially from Vice Chair of Supervision Michael Barr, that this was mismanagement. But at the same time, you did see these lawmakers say to the regulators, if you knew that there was issues at these banks, why didn't you step in? I think the quote was from Senator John Tester of Montana, a Democrat, and he said it was clear the regulators knew what was going on, but no one put the hammer down. And there's going to be a lot of that today.
Was there a cohesive target for lawmakers' anger? And I ask this because we're talking about the potential to crack down on smaller banks, and then they're talking about larger banks having issues, while at the same time pushing a lot of people toward larger banks that have withstood some of the stress in the U.S.
Lisa, the words Congress and cohesive rarely belong in the same sentence, and that is not happening right now. There is potentially one area where you see lawmakers from both sides of the aisle want to have a discussion, and that's about raising the FDIC cap. But besides that, you have Republicans who are blaming quote-unquote woke banks, that was part of the problem. They blame the higher aggressive interest rates from the Fed because of inflation, which they say was induced by the Biden administration. And then you have Democrats, which this was on full display yesterday with Senator Elizabeth Warren, talking about the rollback of Dodd-Frank in 2018. But remember, even some Democrats voted for that.
Amory Horton, I'm going to digress here from the hearings front and center for the Bloomberg world to Axios' report last night of Chris Christie of New Jersey saying flat out he'll never support President Trump again. It dovetails with what Greg Valliere wrote about this morning, which is the likelihood, the weight, W-A-I-T, or maybe the weight, W-E-I-G-H-T, of a third-party candidate for president. Is it too early to begin talking about this?
About a third-party candidate?
Yeah,
yes. I mean, it's too early, I think, in Americans' progress as a country. People have tried this before. It hasn't worked. But what is interesting is potentially you're going to start to see a little bit more of a bigger divide. Obviously, the former president has about a 30% hold on this party, and it's very difficult for anyone who wants difficult for someone in the Republican Party who want to try to separate themselves from him to gain the remainder support. But the race, it is still way too early. But at some point, there could potentially be a front runner. At the moment, it's interesting to hear about Chris Christie, because at the moment, obviously, when you hear from the former president, he thinks it's going to be Governor DeSantis, because that is the individual he continues to attack.
Hey, Anne-Marie, I'd love your opinion on this, because you've done so much reporting from Europe. I think for our international Bloomberg surveillance audience, it's so odd that America only has a two-party system and not more of a mishmash like everybody else has. With your travels, why are we relegated to a two-party system versus a multiple-party system?
Well, we don't have a parliament, which I think John as well has talked about a lot on this program. So it's one party rules all for how the American system works. It's not that you have to set up coalitions. We've seen in the past in America, obviously, independents try to have these third-party bids. And yes, names have... Yeah, well, they make a name for themselves, but it is incredibly impossible. I mean, people like Senator Joe Manchin. There's been reports that maybe he would run as an independent in 2024. Wow. But this stuff, this is very, very, very unlikely.
You liking this, John? I mean, this is just like
not really.
It's like American civics.
I mean, I'd rather get back to the news if we can. So, AMH yesterday in front of the Senate, today in front of the House. What was left out yesterday that you think needs to be covered with these supervisors, the U.S. regulators later?
Well, I think one thing that potentially is interesting, and maybe we're going to get Fed Chair, Vice Chair Michael Barr talk about, is there is a bipartisan bill being introduced by these two individuals that you don't see names together a lot, Senator Elizabeth Warner and Senator Rick Scott of Florida. And this is about an inspector general at the Fed, and they say that instead of the Fed governors anointing who this person should be on the Fed board, it should be the president, and then the Senate confirmation hearing. So I think maybe you're going to see a little bit more heat put at these regulators and their supervision of the banks today. Remember, things are always a little bit more rowdy in the House than they are in the Senate. But at the end of the day, and a congresswoman told us yesterday, a former congresswoman, Stephanie Murphy, told us on Balance of Power, remember, and she's been in these hearings are literally only about promoting performative actions for individuals to run on, less about getting to the nitty-gritty details.
The YouTube clips for their constituents. You know, it's often the case. Anne-Marie said rowdy. I mean, I think some people would say about the House maybe less focused than the Senate when these hearings take place.
Yeah, but she's the host of Balance of Power. She's got some leeway there. She can do that.
You got something to add there, Lisa?
Nope, I'm good. I'm good.
I mean, keep digging.
Well, this is the issue, is that, you know, it's whack-a-mole of anger. It's sort of trying to figure out where to put anger today, and then basically to get people riled up, and there just isn't cohesion on how to do that.
Let me get in front of my April plea that John hears once a month at the beginning of the month. Can we just have the British system where the campaign is shorter? That would just help everything.
Well, it's not. I've heard an argument for it that it gives you time to shine a light on the candidate in a way that maybe other systems don't. I don't know how convinced you are of that, Lisa.
Well, I just think that I'm just curious about that Long Island congressman right now, currently.
How'd that work out?
I mean, there was a lot of vetting time. I don't know. I'm just saying, theoretically, what are we doing here?
Equity futures on the S&P up 8 or 9/10 of 1%. Yields lower by a couple of basis points, 355. It's day 2 on Capitol Hill. For the Vice Chair of Supervision, Michael Barr, a little bit later.
you're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it is causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it's very different, and it's not something people have had to operate in for a long time.
Our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Morning to you on a Wednesday. It's Remember the Day of the Week. Struggling with that at the moment. Equity futures up on the S&P, on the Nasdaq too. Grinding higher by 0.8% on the S&P 500. On the Russell up by more than 1%. The small caps doing nicely. In the bond market, all over the place through the week so far. Just going through the week on a US 2-year. Were we up 20 basis points, up 8, all over the place, and now down 6, down 2? Make your mind up, Lisa.
I don't understand the 2-year. The 2-year is giving me angst. Honestly, at this point, are we pricing in rate cuts? Are we pricing in disinflation? Are we pricing in some sort of financial crisis? And if so, when are stocks going to wake up?
Ask me in 5 minutes.
Okay, thanks.
Down 23, or rather up 23 on Monday, up 8 yesterday, and down 3 this morning.
Don't you guys have the feeling like you take the surveillance nap, or we're just waking up, or whatever? You don't know what's going to greet you on the cell phone.
Which is why
you pick up the phone and it's like a mystery. If you go to the Bloomberg Terminal app, you just don't know what's going to greet you right now.
There is a sense at the moment, Tom, that no news is good news. Without a doubt. The fact that we didn't have to spend another weekend talking about failed banks.
Hallelujah.
An improvement, and maybe that explains more than anything why the 2-year yield was high Monday morning.
So then why is it lower today? I mean, honestly, it's hard to explain. Is this basically people stopping out shorts and then hedge funds going into long?
What has your spread market done? I mean, some of this is learned by quality bonds and by high yield. Are they cooperating with a recovery to norm?
Depends which. I mean, we heard it from Brian Weinstein. He's loading the boat with respect to senior bank bonds of top-rated banks, and you have to wonder if others are doing the same.
Back to something like 500 basis points over on high-yield spreads. About a month ago, that was something like 390. So we've had a break of 4, 5, and then back down again.
We got a busy section here, but I'm going to bring this up for 30 seconds. I'm reading a lot about commercial real estate. I'm trying to get smarter.
What are you learning?
I'm learning that it's beginning to affect Class A property. It's an assumption BC is weak. And I'm beginning to learn that there's a lack of transparency of what it means for, off the top of my head, 200 banks. It's not about JP Morgan or Bank of America.
I'm learning that the pain that everyone's saying is going to come is going to affect a lot of other institutions, and people are examining which institutions are heavily invested in some of this debt. And I think that that's really the key that people are looking at right now.
We can't get away from the banks, can we?
No. Because
no, well said, yeah.
That's been the issue.
Do you want to talk about the banks?
You're going to do
touch on the banks,
let's talk about UBS. Okay, let me talk about UBS, right? So they are acquiring Credit Suisse. We did hear about the Senate Finance Committee coming out with some pretty explosive language this morning. Those shares up 2.7%, at least those, the American Depository Receipts. I want to bring you this. UBS's chair recently said, we have to let everybody go through a culture filter to make sure that we do not import something into our ecosystem that causes issues. So I'm glad that I'm not being filtered through a culture filter. But
did he elaborate on that? What is
he
that?
Basically was talking about not wanting to create something bad from the virulent elements.
The other one's toxic.
Suisse. That sounds like what he's saying.
John, 2 hours ago, I copied and pasted that out of a German newspaper headline because I didn't understand the German, And it was the culture filter thing.
I'm not sure. I want to really think about this, and I'm not sure what I would feel if I were a Credit Suisse employee that knew that I was going to be going through a culture filter.
You've got to be super careful about language like that.
Yeah.
On a lot of levels.
Like super careful.
I think we should send Pharaoh
on a lot of levels.
Lisa,
My frustration with that, and I've gone back and forth on this over the last several weeks, we all know some supremely talented people
that
have worked at Credit Suisse for a long, long time. If you're talking about management, name them. Don't sit there and tell the whole workforce that they need to go through a culture filter.
I couldn't agree more. Don't taint an entire group of people, a lot of whom are really excellent, with some sort of negative brush that they're lesser than coming into our organization.
I think, Lisa, we got to send John to Zurich. I
so
mean,
the other,
just want to get rid of me to Zurich.
Let's also talk about expensive yoga pants because I enjoy them. Lululemon shares are jumping this morning ahead of the opening bell. They reported earnings that were better than expected yesterday, talking about how their full-year sales will grow about 15% to $9.3 billion versus the $9.1 billion that people had been expecting. People still really enjoy yoga pants. I'm just saying, theoretically, some people even
You're talking
wear
about
them
yourself again. Are these your stock picks for you?
My stock picks. And then Micron. I just want to let you know.
No, they're not, Tom. They're really not.
Micron, we've seen a really rough run, and there's been a big question of when is the bottom in semiconductors. And it seems like perhaps the worst is over, and that's why you're seeing a lot of semiconductor shares up, but particularly Micron, which reported earnings yesterday, 2.4% gain, talking about bigger than expected sales in the fiscal third quarter. Again, have we cleared out inventories? Are we beginning fresh? And can people start going into some of those areas that were beaten up last
Bring up that board again. On radio, it's real simple. It's a list of the stocks that Lisa kills every morning. And I really like the idea that you dovetailed Lululemon with Micron, which is the thickness of Lululemon cloth, from what I could tell. I like how you did that. Lululemon and Micron. That was brilliant.
Would you like another word on Lulu? Or are you...
I think I'm good, but I just want to say this. I'm so glad we're not just putting up 5 bank stocks every morning. I actually really enjoy that we're looking at other companies and other corporate stories.
And the VIX under 20 is important, 19.25.
The president says it's over. Just so you know, it's settled down.
And he's buying Lulu pants, too.
It's good.
Just kidding.
Can we continue here? Stumbling through a Wednesday, Edward Al-Husseini joins us right now, senior interest rate strategist at Columbia Threadneedle, and really being in the news with a nice write-up, I believe, in the FT recently. Ed, I'm going to cut to the chase, and you nailed this working in international economics at Harvard years ago. So much about these moments and these crises is fear of making a mistake. That invades monetary policy, including Martin Wolf's wonderful essay today. What are we afraid of making as a mistake in our new central bank policy?
Yeah, and it's difficult because you're balancing 3 different elements. You don't know what's going on with inflation. You don't know how quickly monetary policy is filtering into the real economy. And now you don't know what's happening with the banking sector and the extent to which that's going to affect growth and inflation down the line. And you have to prioritize these unknowns. Inevitably, in my mind, the Fed's going to prioritize inflation.
They have to prioritize inflation. We've got a dual mandate. Maybe we have a triple mandate, as Steve Roach invented, talking about financial stability. Can financial stability weigh in on a May 3rd Fed meeting debate?
Very unlikely. In my mind, they've done a really good job of separating the two, at least on paper. In practice, more than anything, they've been lucky in the sense that this particular banking crisis particularly hasn't spiraled into credit markets. So I think they can take comfort in the fact that the liquidity facilities they put in, what the FDIC has done, that's ring-fenced some of the issues, at least at this point. And again, when they get to the May meeting, it's more likely than not that they'll be able to refocus on inflation once again.
Does it make sense to you that we've priced in, at one point, almost 100 basis points of rate cuts by early next year? We've retraced that a little bit, but not that much.
It's been very violent. It's been exceptionally violent, right? So we went from, a peak rate of, 5.7 and the Fed on hold in the second half of the year just 3 weeks ago to now the Fed entering an aggressive easing cycle in the second half. Which scenario is most appropriate to the data? I would say something that's closer to a hold. But now that the banking system genie's out of the bottle, it's exceptionally difficult to price out an easing cycle and a recession being brought forward, and that's what markets are really struggling with.
So here's the dissonance: risk assets are rallying, perhaps because you're seeing perhaps a slower pace of rate hikes or rate cuts. Does this make sense if the only way that we get that is with the pain that comes with some sort of either crisis or massive credit tightening?
Yeah, it's been interesting. You know, risk, again, to some extent is reflecting two things in my mind. One, the underlying strength of the economy and the underlying strength of corporate balance sheets is still with us. That's something we entered the year with. We've talked to that, at length. And has been one of the frustrations for the Fed. The other thing is interest rate volatility, which exploded in the course of the past couple of weeks, is starting to cool down, particularly in the longer part of the curve. That's a positive backdrop for risk assets. We see it, let's say, in investment grade markets starting to open up. Not quite so primary markets in high yield. So it's a different degree of tension that's priced across risk and rates at this point. I would expect those two stories to connect in the coming months.
If the Fed does cut rates as the market's pricing in, do you start to get less constructive on 10-year treasuries, which you have been perhaps overweight?
We like them. I mean, look, if the Fed cuts, one of the things that the last couple of weeks has illustrated to us is that treasuries once again play a very, very effective role as a buffer against risk. That negative correlation between rates and risk returned in the course of the past 3 weeks as people sought a safe haven asset in the face of heightened recession risk. That's fantastic. So if the Fed's cutting, they are seeing something on the horizon that's disinflationary, that's bringing down inflation, that's potentially bringing down growth. That's a really good story for treasuries. We can argue about where you want to be on the curve in that kind of environment, but you want to be long duration and long interest rate risk in that environment.
Hey, Ed, great to catch up as always. And now Hussaini there of Columbia Threadneedle. Ed, thank you. I can't believe how long the month of March has felt. You've still got a few more days. And Ed mentioned there where the 2 years been over the last month or so. The high, the intraday high, 5.08%, March 8th. The intraday low, 355, March 24th. So you've got an intraday low of 355, a high of 5.08%, and a couple of weeks separating them, Tom. We've gone from no landing boom, Chairman Powell's talking maybe 50, to disinflationary bust. They're going to start cutting interest rates by what, Lisa? 100 basis points?
Almost 100 basis points, yes.
In what, a number of weeks? 2-3 weeks?
Well, that's the broader view, and I think you nailed the framework of it great, but it's even a more narrow view of looking 2, 3, 4 days. I wasn't even aware that early this morning we had a 4.1154% 2-year yield. So there's not only the broader volatility you talk about, there's almost an intraday cacophony to it.
Well, Ed talked about the violence of the Fed rate hiking expectations and rate cutting expectations. And just to give you a sense of how violent it was, on March 8th, when you saw that high, that intraday high, you saw a Fed funds rate anticipated to be almost 5.5% or more than 5.5% by year end. Now we're pricing in a 4% handle, perhaps even lower by then. So here we're talking about a massive shift in perception and monetary response that's getting priced into the market.
So that senior loan officer survey that we get.
May 8th.
May 8th, you're ready, aren't you?
Oh, yeah.
When that comes out, if you don't see exceptional tightening, tightening in that, and you've gone a few weeks without another bank failure, are we going back to the old story? How long before we do that?
This is the reason why I wonder if there's a risk for 10-year treasuries. I wonder if there's a risk for inflation expectations, especially if the Fed does go ahead and doesn't cut rates, or doesn't hike rates, excuse me, going forward, doesn't necessarily get more hawkish.
When we're all together, she can frame her gloom better. It's a better gloom when you and I are together.
This is a more exceptional gloom?
It's a more clearer and...
A more polished gloom?
Clarified, polished.
It's a polished gloom.
Posh
more
as well.
depressing gloom.
It's a very posh gloom.
It's a polished gloom.
Distilled gloom.
I hear Tom Michaud's going to join us later, the CEO at KBW. We'll do that at about 8:30 Eastern time, so let's call it 50 minutes from now. Equity futures up 8 or 0.9%. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. UBS is going back to the future. Sergio Motti is returning to the bank of chief officer to oversee the acquisition of Credit Suisse. Motti will replace Ralph Hamers, who has been in charge for just over 2 years. He'll retake the role he held for 9 years after the annual general meeting happening next week. Now, President Joe Biden and House Speaker Kevin McCarthy exchanged dueling letters in a fight to over raising the debt ceiling. McCarthy is demanding that negotiations begin on a series of spending cuts and regulatory changes. The president responded by challenging Republicans to produce a public budget plan. Now, President Biden is urging Israel's Prime Minister Benjamin Netanyahu to reach a compromise on his controversial plan to overhaul the courts. The proposal has sparked protests across Israel. The president told reporters, quote, they cannot continue down this road. Vladimir Putin's drive to expand Russia's armed forces is adding to labor shortages. The war in Ukraine has drawn hundreds of thousands of workers into the military from other sectors of the economy. Government data suggests a net increase in Russian military last year of approximately 400,000. That comes at a time when unemployment is at a record low. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Clearly, I think markets are feeling relatively relieved. We are seeing, obviously, markets repricing the degree of Fed tightening. It's too early to say that the Fed should be cutting this year, but I think the recalibration in terms of the terminal rate in the US, I think, is relevant.
That was Jeremy Stretch there, the CIPC head of G10 FX strategy. Philip Lane of the ECB spoke this morning, the chief economist, in an interview, and he said, we expect these tensions will settle down. More hikes will be needed. They often refer to their baseline view. It's like saying, well, this is what we think is going to happen, might not happen, but if it happens, this is what we think we're going to do. And ultimately, the baseline is this will settle down, and Tom, they're going to keep hiking.
We need to talk about this for 30 seconds. We got Mandeep coming on, but this is really, really important. Are we still in an inflationary worry, or can we look as Torsten Slok is looking at disinflationary vectors? Professor Lane is saying, no, we have an inflationary worry.
We have an inflationary worry. There is a thought here in the US that maybe we have a dirty disinflationary solution,
listen to you.
Given what's happening in the banking system. And it's not happening in quite the same way in Europe, Lisa, and maybe that's the important distinction.
Remember when we used to talk about the transmission mechanism of financial markets, and now we don't care anymore if there's sort of some sort of decline in yields and stocks go up, then that's a good thing for the economy. Well, I think that probably the ECB feels a little different, because I'm looking at German two-year yields at 2.6%, down from a high on March 8th of 3.33%. So they keep saying, we're going to hike more, we're going to hike more. And bond traders keep saying, no, you're not, no, you're not, no, you're not. And it's basically consistent. So the more they talk, the more people just say, you guys don't know what's going on.
The US issue, though, has sort of evolved in a subtle way. It's no longer just about the price of money. It's about the standards around through which the money will be lent on at that price. That's a difference, and I think that's what we're looking for in the data on what day?
May 8th, yes,
just to
that's
see
correct.
how much they've tightened things up. It's not about whether I can get a loan now for 4 versus 5 or 6 previously. It's whether I can actually get a loan at 4 or whether I'm declined because people don't like my credit profile or something like that. Whatever.
I don't know. And
Sure.
again, we mentioned the commercial bank overlay, the commercial real estate overlay, I should say later, and that's got to get out to announcements from May 8th. We're going to digress right now, and this is going to be a lot of fun. Mandeep Singh with us now, of course, senior technology analyst at Bloomberg Intelligence, and he lived, and I knew of the oddity. No, all semiconductor research in America did not come out of San Francisco, Palo Alto, and on down south. Came out of Boise, Idaho. And long ago and far away, potato money in Boise, Idaho invented and supported Micron. They reported yesterday, maybe the great unknown in the semiconductor business. I want to get to the metaverse, Mandeep, but very simply here on Micron, who are those guys and why was that news yesterday important?
Well, so Micron is the bellwether when it comes to semiconductors, simply because memory typically bottoms first. When you're talking about trough in a semi-cycle, memory tends to bottom first. And they gave some encouraging news around, incremental demand getting better. I think where we still have unknowns is how quickly will the PCs and the smartphone market rebound, because half of Micron's revenue is PCs and smartphones. Yes, data center is strong, autos is strong, but that's not the big revenue generator right now for Micron. And so I do think they talked about, cutting CapEx, so that will bring the market to an equilibrium in terms of the inventory that they are carrying. And they wrote down a lot of the inventory, which is why they had negative gross margins. But clearly, I think there is lack of demand, especially on that device side. And that was something not clear on the call.
Mandeep, I'm going to segue here from semis, potatoes, over to the metaverse. I thought Paul Kodrowski was brilliant yesterday in the Twitterverse, talking about the death of the metaverse and when Facebook renames itself back to Facebook instead of Meta. How close are we to the death of the metaverse?
I think based on, Meta shifting to an era of efficiency, it clearly suggests they are focused more on the revenue generating aspects of their business, which is really focusing on ads and, the core feeds and the video ads business. And I think metaverse is still a 2030 thing. What I'm yet to see from Meta is, just cutting back on spending when it comes to the CapEx side of the equation. They're still very aggressive when it comes to CapEx spend on building the metaverse. And probably they will cut back because there's nothing on the horizon that suggests you can monetize the thing right now.
Mandeep, let's put these two ideas together. This question of Meta unable or unwilling to really invest significantly in capital expenditures. And at the same time, the likes of Micron and NVIDIA count on that type of capital expenditure by large businesses in order to really grow what they do. So how much is Micron, okay, yes, they might have beat pretty low expectations, but how much are they seeing, or are you expecting to see the potential consequence of declines in capital expenditures?
Well, so Micron themselves are cutting CapEx, which is going to impact the semi-cap equipment guys. So clearly there is a chain in terms of, who spends what in terms of CapEx and how it impacts the customers and suppliers. And in this case, I think with Meta, the good thing they have is they are using a lot of that CapEx spend in terms of developing their AI capabilities. Now, a lot of AI and large language models go into their core business as well in terms of what they can do, with regards to showing more personalized ads and offsetting some of that Apple changes that really was a big pricing headwind. So not all of that CapEx is going towards metaverse, but a large chunk is. And so that will have a trickle-down impact on NVIDIA and all the chip names, because that was one of the biggest drivers. You're right. Their customers, the chip customers, are very concentrated. It's the hyperscale cloud guys. If they're paring back on CapEx, that will have an impact.
I'm looking right now at some of the gains, and they're pretty incredible. NVIDIA shares are up more than 130% since the low in October. Does this all make sense to you, the incredible rally in semiconductors, basically off of, potentially extremely dire expectations last year?
Yeah, so I go back to my comment that I made earlier that they trough at different times, and so definitely memory seems to have troughed. You can't say the same about, the overall chip market because autos and data center spend has held very strong. These guys haven't even seen a slowdown, forget about a trough. But on the PC and smartphone side, I do think we are close to a trough, and that's why the more diversified you are as a chip company, the better off you are, which is what we are seeing with some of those companies, NVIDIA, AMD, et cetera.
Hey, Mandeep, thank you, sir. As always, Mandeep Singh there of Bloomberg Intelligence. Lisa, like you, the first thing I thought when these numbers came out after the close yesterday, okay, don't care about that company. What's the macro read?
Yeah.
What's the story here for the economy?
Obviously. That's really my question is basically, are you starting to see more capital expenditures? Are you starting to see people, basically people saying, we've bottomed out here, we can go ahead and buy more PCs and more, computer devices for our children that maybe have already broken all the ones we bought during the pandemic.
Okay, and whether personal again.
I'm just saying this could be a story people are going to.
So think about how the year started. China's reopening. Story's going to change. Reflation, problematic for the US. How much has that changed? I mean, I've barely heard about the China reopening story at all over the last couple of weeks. The story's just kind of gone quiet as commodities rolled over.
And we've seen perhaps data that also is disappointing in terms of how quickly they've gotten back up to speed.
Yeah, Win Thin was brilliant on this a couple days ago. And Dr. Thin of Brown Brothers Harriman made clear that we're looking at it in a prism of trade and China's international development. And what they really need is a domestic recovery. And they're seeing that domestic recovery. And it's so regimented there in terms of manufacturing and labor processes, it takes time. So maybe we'll see that domestic recovery, and then maybe you see Australia do better, in the stereotype.
So we've gone from bank cuts, recession to no landing, lots of rate hikes.
It's a narrative of the day,
and
right?
now all of a sudden it's rate cuts again and disinflationary bust.
Correct.
Am I right?
It's basically.
And where's it going to be in 2 months?
Well, I will tell you.
Or tomorrow.
Exactly.
5 minutes.
Wait, so hold on a second. I have a serious question for you.
Sure.
Are you ready to write your March 31st year ahead outlook? Do you feel like you're in a better position now?
I've got a couple of days, haven't I?
Okay, but do you feel like you're in a better position now than at the beginning of the year?
I'm definitely in a better position now than at the beginning of the year.
Punch. Yeah,
I'll put that outlook now. I'd rather put that outlook out now than 3 months ago.
The bar is pretty low. I mean, come on.
But John, while you were gone, I went to levels. S&P 4,000. Dow 200 points from 33,000. NASDAQ is near, I never thought I'd say this, nearing 13,000. The levels shot within our numbness of crisis. These equity levels, I think, are stark. They don't scream bear market. They
The futures
scream,
right
wow.
now, they're doing better, up 9/10 on the NASDAQ. Coming up next, Lee Ferridge of State Street is going to join us very shortly with an equity market that keeps improving by the minute, near session highs.
Welcome back to another Miami Open update for Bloomberg TV and radio from Tennis Channel. I'm Johnny Ray Diaz. Aussie Open champ Aryna Sabalenka faces Sorana Cirstea Wednesday for a spot in the semifinals. The Belarusian took out Barbora Krejcikova in the third round. That was her 20th win of the season. That's more than any other player on the WTA Tour. And don't forget, you can watch all the action exclusively live on Tennis Channel.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
News breaks. No one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of 3 very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021. And now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compaq merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
The Fed narrative is certainly an uncertain one in the context of those long and variable lags in terms of policy.
I think that they can just take a pause in that rate hiking cycle.
Depending on what analyst you talk to, it could be anywhere from 25 to 100 basis points of rate hikes that they have seen because of the crisis that's kind of now built in.
I think at the end of the day, what the Fed feels relatively confident about is they can handle what's going on in this situation.
I don't know that we need to fear the current rate regime.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Crisis over on a Wednesday. Coming up on Claims tomorrow. That will be interesting. All three of us together today on radio and on television. And John, for me, the headline item off the data, which speaks to the healing over the trauma, all the great coverage you and Lisa did there with the Fed show, the Sunday special, and that. You know what? We had a 4.11% two-year yield for a cup of coffee early this morning. It screams a little bit of calm.
We need to go to the calendar. April 7th, payrolls, no one cares. April 12th, CPI, seemingly no one cares.
Yeah.
April 13th, First Republic reports earnings. Then you go to April 14th and you get earnings from JP Morgan. I think there's a decent argument to make here that the earnings from the banks and the guidance they give us is perhaps more important than the incoming information. So when the Federal Reserve says, and Lisa and I talked about this repeatedly last week, when they say we're data dependent on what data now, given the developments of the last couple of weeks?
Absolutely brilliant. I missed that because I was having a 3-island tour. And the answer is, John, the answer is Diamond's going to speak. Diamond, through that press conference, is going to give his opinion. And this is about deposit flows in and out, the dynamics of money market funds. Is that data more important to Chairman Powell now than the macroeconomic data Mike McKee follows
and as
every
Lisa
day?
mentioned, it's no longer just about the price of money. It's about the lending standards around the price of money and how much they tighten, Lisa, in the weeks to come.
I do wonder, though, if JP Morgan's really representative. If there's a divergence really opening up here between some of the smaller, the regional banks that perhaps are seeing more stress and constraining lending more at a time when the JP Morgans of the world don't see the same sort of stress in their business. In other words, which data, which viewpoint are we going to really understand the microeconomics that are going to underpin the next leg of this cycle?
I mean, Schwab with some challenges here. That's been in the press, but is Fidelity the JP Morgan of money market funds? I'm asking that. I don't know. I don't know the answer to that. But money market funds play into this.
The incredible surge of cash into money market funds will also be something that a lot of people will be looking at, because where is that money coming from? Is it just sort of a rearranging of bank deposits from smaller banks into money markets? Is this going from risk assets? Is this basically sort of de facto credit tightening as seen through these flows? These are sort of some of the things people are trying to dig beneath the surface.
John, what do you see in the bond market?
Now?
Are you looking at German yields? Or are you looking at, I'm looking at the 2-year, but is there a nuance there?
I'm just thinking of the range we've seen through the month of March, and we keep glossing over it and sort of running to the new bright thing and the next narrative, the next regime shift. We've gone from 355 at the low, 5.08% at the high in a couple of weeks, and now we're at 4%. And there's a lot of people comfortable now with the idea that this is it, last 2 weeks, disinflationary bust, rate cuts are coming. I remember 3 weeks ago when this was it, no landing, they've got to do more to try and get that landing, and Lisa, they're going to go maybe to 6%.
Jan Hatzius over at Goldman Sachs saying what a lot of people have been basically trying to say, which is basically that the banking stress does increase the chance of recession, but it is not, as he said, the economic hurricane that a lot of people are expecting, and that he only expects a 35% chance of recession this year. If that's the case, two things. Number one, does that mean that the Fed still cuts rates in response to the banking stress? And is that what enables the U.S. economy to avoid that stress? And number two, does that really mean that it's risk on, or does that mean that inflation is going to remain a lot longer, a lot higher? And that's really, to me, those two tensions.
So there's two different decisions here, and the market behaves like there's only one. The Federal Reserve makes the decision to pause, and then they make a separate decision to cut. The market decides that pause is the start of the cuts. They just think that it's the same process, ultimately. I think for the Fed to stop and then just stop is a very different story to the Fed that starts to go on this massive cutting cycle. You mentioned Wei Li of BlackRock earlier in the week, and you and I talked about that this morning. She's pointed this out at BlackRock. We're reaching for the old playbook, just like that already. First sign of stress. When we spent the last 12 months saying the Fed put us gone, the story's changed, and if we get into trouble, maybe they pause, but that doesn't mean they cut all the way back to 3, to 2, to 1, and who knows next. We'll see, Tom, but this is about the reaction of the Fed and whether we are truly in a new regime, given where inflation is.
Even in crisis, they're data dependent. It's about labor. I mentioned claims earlier tomorrow, getting it out to some quote-unquote normal number. And the other is, do we begin to see any form of disinflationary ebb in services, as say Torsten Slok at Apollo or David Rosenberg at his own shop in Toronto are talking about? And to me, that's the heart of it. John, we got to look at this data because it's more correlated today, optimistically, than anything we've seen. I'm going to start, John. Oil, $74 American.
No banking crisis, no news on that, and good news for this market. For now, equities up by 0.8%. I think the president came in yesterday. The president said a couple of things yesterday, and when he says things like, it's not over yet, I'd never advise that. Usually they say we've got it under control. The president also said that things were settling down. They're settling down, and that's hard to disagree with based on the lack of news in the last week. I mentioned equities up by 0.8%. If we can get back to that board, I'll go to foreign exchange just briefly. This story about the divergence that could emerge between the ECB and the Federal Reserve. Where does that leave euro dollar right now, Tom? 108.50.
Yeah, well, it's a nice little lift up there. These are some of the tweaks that tea leaves were looking at. Someone doing that as well with decades of experience. We lean forward for Lee Farage, head of macro strategy for North America. It's State Street. I love Lee, the Farage sarcasm, the bank crisis. It should be over. I just love that as well. You've seen a few of these, unlike me. When you see a bank crisis, how do you know when it ends?
You don't know. You don't know when it ends. It's just time. You know, time is the greatest healer, Tom. And look, another day, no more bad news on the banking side. Increasingly, it does look like this is not a systemic problem. This is idiosyncratic. You know, a couple of banks we've seen, we know about over the last couple of weeks, but really, you know, since Sunday before last, things have started to calm down. And the fact is, if this is it, which increasingly looks like it is, then we do need to go back to sort of thinking about the Fed of a few weeks ago. We do need to go back to looking at the data and saying, well, okay, so what's really changed? There's going to be some tightening in lending standards. There's going to be some pullback in lending. We know that. But how much? How much if this is it? And we're done here in terms of the banking crisis for now. The Fed can't rely on some big pullback in lending in order to do the job on inflation. They have to carry on doing what they're doing.
So, Lee, people believe that the Fed is in the business of breaking things because they have a history of breaking things. The Fed believes they're in the business of risk management. So given the risk they've got to manage and the information they'll have between the start of May and now, do you think they'll get sufficient information to make the call to hike interest rates?
Yes, I do. On the basis that if between now and May, we have no more continuation of the banking crisis, the data continues to be strong, which every indication is it will, then that's enough. Yes, that's enough for them to hike again in May. Assuming nothing, we don't break anything else in the banking sector, then yeah, why wouldn't they go in May? Don't forget, it was 3 weeks ago that Powell spoke to Congress. And right then, we were pricing a terminal rate of 5.7%. We had year-end rates at the end of this year at 5.5%. We're now at 4.90 terminal and 4.20 at the end of the year. But if this has been contained to what we've seen so far, does that really change the environment that much?
But Lee, you actually are expert at understanding the dynamics, the technical underpinnings of a market that has whipsawed up and down and been incredibly volatile, the most volatile that we've seen since 2008. So how vulnerable is this particular fundamental ecosystem to some sort of shock where the Fed says, you guys are wrong, we've been telling you this, and we're going to hike rates, and guess what? We're seeing something different than you are.
Look, we had some very volatile days, for sure we did. But the system overall stood up. It was volatile, but it stood up. And let's be honest, we have, we've got 5 weeks of messaging here that's going to come through. We've already seen, look, last week we had 115 basis points of cuts priced in by the end of this year. We're now at around 60. So we've already seen some sort of repricing. Nothing's broken. We've repriced a bit. Everything's working sort of pretty well. So, can we reprice more from here? Yeah, absolutely. We won't get back to where we were on March the 8th, not anytime soon, but there's room for rates to move back higher, I think. Again, we have to assume that we're not going to see any more on the banking side.
And John, with your travels here, I mean, we do have Lee Farage on the line right now.
What would you like to ask?
We've got to talk about the unimaginable.
What's that?
My favorite Liverpool is the guy that goes right for the net, mental.
Mo Salah.
Salah. Could he actually leave and go to Spain as ESPN is writing about?
I was going to ask Lee about the equity market, but why don't you ask Lee?
I mean, Lee, help us here. John and I are designed to know, is this the breakup of your beloved Liverpool?
Been breaking up for a little while, Tom. Sadio went last year. Mo's still there. He signed a new contract. I think Mo will stay.
Okay.
I don't think he's going to go to Spain. He'll stay.
You miss Mane, don't you?
Do miss Mane.
I think you miss him a lot.
Last time I was on, you asked my prediction for Liverpool, Real Madrid, and I told you 2-0 to Liverpool. I was right for 18 minutes, then we lost 5-2.
Hey, Lee, that was great. Lee Farage at Stage 3. Lee, thank you. He was right for about 18 minutes or something.
This is, I don't even understand what we're talking about there, but the answer is...
Well, thanks for bringing it up.
No, but I'm bringing this up because so much of our audience cares about this on radio and television. Boy. But, John, help me here. The 4 teams... It really matters if you come in 4th in the Premier League,
to play
right?
Champions League football, yeah.
And Liverpool's not doing that, and so these hitters are like, we're out.
Well, they might make it. Spurs are struggling. It's going to be a competition with Newcastle and maybe a couple of others as well.
But Liverpool is
They should
out.
be up there. They should be. But then what's happening with John Henry and the business? What's happening with Fenway Sports? And
we'll have to see
about
what
happens with Liverpool. Wasn't there a sale and now there's not a sale? He can't get his price.
It's a partial sale, is it? I mean, it's very partial, sort of. It's a.
I think it's interesting, Tom, that people as sharp as the Glazers, as Henry, for instance, may be looking to exit. I just wonder what that says about the valuations in football at the moment, but
we'll have to see.
We can do that another day.
I got 3 emails just here in 10 seconds. Thanks for the football talk.
Yeah.
Where's it been?
Where's the equity market talk was my message, but
really
another time.
We're up big. We're up a stick.
We're up 0.8%. Mark McCormick at TD joining us shortly.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Swiss banker Sergio Amotti is returning to the role he had for 9 years. Amotti will once again be the CEO of UBS to oversee the complicated acquisition of Credit Suisse. He is replacing Ralph Hamers, who has been CEO for just over 2 years. Amotti will take over after next week's annual general meeting. Hamers will stay at UBS for a transition period. Meanwhile, a US Senate committee says that Credit Suisse is still helping rich Americans hide assets from the IRS. That is almost a decade after one of the bank's units pleaded guilty to tax evasion conspiracy. According to a new report, Credit Suisse worked with dual citizens to conceal assets from tax authorities. The bank says it does not tolerate a tax evasion. Ukraine's President Volodymyr Zelensky is warning that a Russian victory in the city of Bakhmut could be perilous. He told the Associated Press that Moscow could then build international support for a deal that would force Ukraine to make unacceptable compromises. Zelensky has also invited China's President Xi Jinping to visit, despite China's ties with Russia. Now, the CEO of Macy's, Jeff Gennette, will retire in February after 7 years of leading the department store. He'll be succeeded by Tony Spring, who serves as president of Macy's and CEO of the company's high-end Bloomingdale's chain. Gennette has led Macy's through a turnaround plan, which included shop closures and new store formats, job cuts, and also a focus on digital offerings. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
If you're in a board meeting or something like that, does your assistant tell you that there's a call from the Secretary, Treasury, or Chairman of the Federal Reserve, where they put that right through, or do you say, I'll get back to them when
My chairman sitting in front of me here, you can attest that I will dump the board to pick up Janet Yellen or Jay Powell.
Hi, I'm Francine Lacroix. Join me on Leaders with Lacroix as we explore what drives the most influential people on the planet. Leaders with Lacroix on Bloomberg Television, TV Go, and Bloomberg.com.
Look, this is a banking crisis, but the reason, I think we're calling it that, I guess, at this point, but the reason we got there is very different than a lot of other banking crises. It wasn't because of bad assets, right? It was because of duration, really, more than anything. There will be eventual impact in terms of, okay, if banks are lending less, that has to have an impact on corporate America.
That was Brad Rogoff, the Barclays head of FICC research, amongst other things. Tom, you can sense the nervousness there around calling it what it is, a banking crisis. And one thing that's come up over the last 24 hours after that testimony from the Vice Chair of Supervision of the Fed, Michael Barr, is the speed at which some of this happened. And Lisa, there was this reference to this number. 100 billion was about to go out the door of SVB on Friday. And everyone's talking about the age of digital banking, and I totally understand it. I think it's a valid conversation, it's important. But when it comes to SVB, the speed was a reflection of the character of the deposit base. Lisa, it wasn't just the speed that broke things, it was the character, the nature, the concentration of the deposit base that led people to see how quickly things played out.
The digital aspect was the reason why we didn't see people in line waiting to get the deposits out of the teller's window. And that's really the key distinction here. But it isn't a sort of necessarily the reason why all of these deposits were withdrawn. And that is to your point. When there are problems with the oversight, when there's problems with the risk management, then you have problems with people not wanting to put their money there. It's not rocket science.
Well, to make it even more simple, Tom, there's a difference between a small number of big hands and a big number of small hands.
Yes.
And if it's a small number of big hands, you can move 100 billion just like that. That's the reflection of things. And the speed was just a reflection, at least for me, Tom.
You're killing me.
The speed was a reflection of that.
You're going to get me in so much trouble here. I said this, and I had to be put in a timeout chair by a number of our listeners and viewers. Is SVB a bank?
Well, you and I had an argument about this a number of weeks ago. It's a bank. It's just a different kind of institution.
It's a new kind of entrepreneurial bank without interest rate discipline is about where I want to be right now. I mean, it's just as simple as
I know that, Lean. If you're on radio, it's amazing.
You catch it on the Bramo cam. We've got sensors on the Bramo cam where a red light goes
I sit here in the middle trying to read body language, and reading Bramo is just brilliant because when Lisa's got something to say, she leans away from the mic when she's got something to say. That means she's really got something to say when she leans back.
I'm trying to restrain myself. Thank you for
and then leans back in. Here we go. Go.
No, I was just going to say, how many other banks are there that are not banks, but really are banks and that are going to fail? I mean, I wonder about that with Signature. It was tied to commercial real estate. It's got all of these other institutions. So how many are wrapped in that kind of wrapper, and then people put their money in thinking that it's just a regular bank, and it's not. That's the point, is that if you have that concentration risk, suddenly you've got systemic risk, suddenly you have concerns, and it gets painted with a broad brush throughout the financial institution.
We're on the same page, yeah. I'm with you.
It'll be interesting to see. And again, these hearings today. Look for balance of power tonight. What time is it? 10 p.m.?
At 5 p.m. I still don't think that's actually what you wanted to say. I think it was something.
No, it isn't. We're still getting a
bit restrained.
It'll come. My bow tie is a disaster today. Saving us, Mark McCormick, Global FX Strategy Head at TD Securities. Mark, how do you write a research report given this chaos?
You stick with the weeklies, you stick with short-term ideas, but you do kind of link it to some of these broader themes that I think are still prevalent that we've talked about a few times already. Like while there's a focus on the shock to the U.S. banking system, it does take us back to old Fed research, which I think is very, very powerful right now, that there's two different R-stars. The financial sector has one, the real economy has one, they're competing, and now we know that the financial R-star is more important for policy. So the other side of it is also there are guardrails to the slowing global economy because China is still coming from through the reopening. Right. It's still accelerating. And so what you have is the FX market is actually kind of clear that this is still being treated as a U.S. shock. Mm-hmm. And this is bad for the dollar in that context, given the guardrails you have around the global economy and the global growth outlook.
I got 8 ways to go here, Mark, but I'm going to get out front of our IMF coverage, folks, which you're going to see over the next couple weeks. I'm looking at some idiosyncratic emerging market tensions, perhaps off a U.S. banking crisis, perhaps off the mystery of central banker to the world, Jerome Powell. What do you see in EM, particularly when I see the blue dollar in Argentina popping out near 400 pesos? These are little tea leaves, aren't they?
Yeah, so I think you have your standard playbook, which is kind of like which currencies have big vulnerabilities on the credit side, which ones basically those vulnerabilities show up in terms of dollar liquidity, and they basically show up in the current account. So you kind of want to dust off the playbook where there's stress coming from the U.S. and which countries are going to have the repatriation coming back into U.S. assets, which is purely a function of the current account. So you kind of have your good EM, your OK EM, and your bad EM. So your Turkey, your Argentina, those currencies are basically still not kind of in the lexicon where I think a lot of people trade them as kind of an EM group. But I think more of the orbit is really kind of thinking how LATAM relative to Asia works in this, because Asia is insulated from this crisis very well. And I think on the other side, LATAM, something particularly like MEX, is something that's very connected to the U.S. growth stories, connected to the Fed outlook. And that's something that's been a very, very, very focused carry trade, which could be vulnerable in this over the next 6 months if the Fed does start to cut.
I think of the dollar as a wrecking ball. It's sort of drives through all of these neat narratives that people put out there and then checks them and is unpredictable. And we've seen this weakening, this great weakening, as people price in rate cuts through the end of this year. If Lee Farage is right, and basically the Fed's going to say, the banking crisis never happened. It's over. It's not going to have a material impact. We're looking at data that's still hot. We're going to hike rates. And we're going to go back to the estimates that we were talking about 3 weeks ago. What does that do to the wrecking ball of the dollar?
Well, it's a great question because you kind of need to think like what happens over the next 3 months and what happens over the next year. I think particularly our view is one where if you look at the correlations, the dollar is much more correlated to rate cuts in the future versus rate hikes right now. I would also stress that when we run like a global macro vol gauge that includes rates, equities, and currencies, the dollar's already trading a premium there. So if you do get what we anticipate as well as a couple more hikes, which are kind of fine tuning, which are a bit more cautious, but the bigger move is for a rate cut cycle to begin next year. Your regime in your yield curve changes. We move from bear flatteners, which is super bullish for the dollar, to something that could be bull steepeners, which as an aggregate is very bearish for the dollar. And again, we still have the rest of the world outperforming the US. So if you get more Fed hikes and you get the idiosyncratic weakness in the US that comes with it, you also have US equities underperforming. So when you layer in the factors that matter for FX, it's rates, it's terms of trade, it's equities now. And those are things that are very important that we see in our framework that tells us what's driving FX performance. So I'd say, yes, if you get the fine tuning of the Fed the way we're characterizing it, the dollar is generally a bit, it's a bit more two-way. Euro caps out at 110. Dollar yen probably peaks around 134. But the next big move in the next 3 to 6 months after that is for the start of a more sustained dollar bear market.
How significant is that? How deep do you see that bear market being?
It can be quite substantial if you look at in terms of valuations and as you mentioned on EM, if we get to the end of the Fed cycle and we're very close to the terminal rate, rates volatility will collapse. Our models already show that rates volatility is expensive relative to macro factors. So you take that out, you get the rotation of capital flows out of U.S. equities into other assets, particularly in Europe and Asia, and you see a push into emerging markets, particularly carry, the high quality carry, and you see a shift to Asia-based growth currencies. Like right now, we like the Korean won. So if you put that all in context, you could see probably at least a 5 to 10% move lower in the broad dollar next year.
Mark, are we missing a piece of this? What happened to the slide to the other side of the dollar smile? What happened to that piece of the whole process?
Well, I think there's two components you have to think about it. So the one side of the dollar smile is the world kind of moves into a full sustained crisis, and the other side is U.S. exceptionalism. What we're doing is we're losing the U.S. exceptionalism piece. If this is a U.S.-centric banking crisis or turmoil or shock, which forces the Fed to change policy because the R-stars are more focused on financial stability than inflation, and if this shock is disinflationary, given the change in credit standards and lending standards and a broader slowdown in the U.S., you lose the U.S. outperformance on that smile. And the other side of it, if this doesn't morph into a global crisis, again, this is not impacting Asia. We are closely tracking banking sector stocks. Biggest drawdown we see is in the U.S. banking sector. Outperformance, what we see is in the European banking sector. Yeah. Eurodollar should be trading at 112 right now off of relative bank performance. So you're losing both extremes of the smile. I'd say that obviously the bigger one is that this could morph into a global pullback, but that is not our base case.
Interesting.
So we could lean there, but most likely this is U.S. underperformance.
We're like hanging out in the middle of the two extremes at the moment, at least. Mark McCormick at TD said it was about rate differentials and then basically said it was about bank differentials.
It's bank stocks. Basically, that's the data we're watching.
Stocks.
It's literally where we're at.
It's nuts. Priya Misra and more in the next hour of Bloomberg TV.
seeds, typically between the time you start and they get out in the farmers' fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg surveillance. Good morning, everyone, on a Wednesday. Claims tomorrow is of interest to me to see if we get any kind of glimmer on a perfectly employed America. Lisa Bramwitz and Tom Keene with better data here. Lisa, let's just look at the data here quickly. I think we've been on top of it all morning, but the bottom line is you walk in, I set up a stick, somebody says, what's that? That's up 1%. And there have been moments here where NASDAQ 100 this morning up 1%.
It's a rolling ball of money. People see that things have sold, and they say, okay, game on, let's go into them. I mean, basically, people want markets to go up. That seems to be the theme. The interesting thing to me is that you see yields down, people going into bonds and people going into stocks. Everything is green, let's go. And it's perhaps the absence of news that's giving them that sense.
What we're going to do on this right now, and it's so important, we're going to get right to it. If you are part of global Wall Street, this is the point where you stop on radio, on television, and you listen. In this banking crisis, you need somebody that is so knowledgeable on it, and at Middlebury College a few years ago studied back the 10 banking crisis back to Jackson. That would be Thomas Michaud. Thomas Michaud is CEO of KBW. We're thrilled he could join us this morning here. Within the crisis perspective is, well, how's the week been? What's the biggest sweat this week for you on a day-to-day grind?
Well, first of all, it's been nonstop. You really can't have markets work and economy work if the banking system's not working. And it's a step beyond that because it creates a lack of confidence. You mentioned earlier about a history of bank panics. You can argue whether it was 8, 9, or 10, but let's say roughly 10 bank panics in the history of the United States. It's not, it is, look, banks made mistakes. We just had the second and third largest bank failure in American history, but the banking industry is built on confidence, and when confidence is shaken, it could absolutely impact the whole economy.
1831, National Bank of Middlebury. A perfect example of a small bank going, wait, they're going to come in here, cash out, and give it to James Dimon? Explain to us the dynamic right now of the national banks of Middlebury out there, scared stiff of those top 5 banks.
Well, so first of all, so it's not only National Bank of Middlebury, which actually is a bank that you mentioned specifically, but the big banks lead the global banking system. This is an industry where the American big banks lead the global financial system. That's number one. But it's really the mid-sized banks that I think we need to talk about. And if, let's just say for round numbers, the big banks today have 60% of the deposits in America, they do not make 60% of the loans to middle America and small America. So if the deposits are going to the big banks, but they're not the ones making the loans to middle and small America, it's going to have an impact on the economy. And I think long term down the road, we're not going to be in a good place. But the last thing is you would say, why is that happening, Tom? Because there's this implicit guarantee that banks can be too big to fail. We just saw it with Credit Suisse. There was really no worry that counterparties of Credit Suisse weren't going to be made whole. And if that is the sense of the land, it's going to drive business away from these mid-sized banks, and I think is going to have a detrimental effect on the economy.
So why haven't the steps that the FDIC, that the Federal Reserve, that the Treasury Department already have taken to basically de facto ensure all deposits for most mid-sized banks been enough to really garner that support that they're backstopped to?
We got close, Lisa, but we didn't go the distance. So Secretary Yellen, when she spoke, still left the door open between implicit and explicit. And look, if you saw what the first reaction was of the FDIC with Silicon Valley, it was to give certificates, not deposits money back. So I think that actually accelerated the outflows of banks on that Friday. And I think what we need is orderliness. My preference would be if the administration came out right now and said, we're going to use our authorities and we're going to say that any bank that fails of any size for the next year, we're going to guarantee the deposits while we figure this out. I think it would be very good for the economy.
Putting long-standing solutions aside for a minute, you talked about how a lot of these smaller banks punch above their weight when it comes to lending. How much have you actually heard of tightening of lending standards, of actually retracing some of the loans that some of these regional banks have been making?
It's going to be the story of the second half of 2023 that is happening. It was happening before we had the recent bank run. It was happening before that. And I'll tell you that story. As soon as COVID started, the first thing that happened over 24 months was about $5 trillion of deposits came into the banking system. We had 13 trillion go to 18. Never in my career have I seen the deposit system grow that quickly. That was the COVID relief and the stimulus coming into the system. It's now being drained as a purposeful part of our policy. So we are probably, according to our numbers, still 10% too high in terms of surge COVID deposits. So the industry's sort of fighting two competitive elements. Number one is FDIC deposits are shrinking as a part of government policy. That's going to be a tightening effect in the economy. And then number two, we have this confidence, which is a little bit shaken, which, by the way, it's gotten better. I want to make sure it's gotten better, but it's still shaken. And that is driving deposit flows, too. So it's really turmoil in the economy, which is going to slow the economy.
Keep talking, you're lifting the two-year yield. I got bad news, Thomas showed for you. You're not the most important person at Keefe, Bruyette & Woods. Jade Romani is. Right now, when you look at commercial real estate and his work in mortgages, and your security analyst, what you guys are known for decades at KBW, Jade Romani is the guy on what's going to happen with commercial real estate. What's he telling you when you call him?
So about a month ago, we came out with this call because the other thing is this banking issue is not just the banking. It's not specific just to banks. What we're dealing with is when interest rates go up this fast, there are implications, and there will be other implications. So we wrote a report about a month ago that Jade led the author, you good memory, Tom, and he said basically he thinks there's 30% downside in office buildings in major markets around the country, with about half of that due to the cap rates and about half of it due just to factors of other factors around occupancy and inflation. You're already seeing it. This is a more slow motion event. It's going to take 2 years to play out, but that's the next asset class.
What's it mean for global Wall Street? What's it mean? I'm selfish here. What's it mean for the people on Manhattan, including Bramo? And what's it mean critically for our viewers and listeners if we're going to see a 30% negative?
I just think it's going to impact economic growth. And I think it'll just mean that we're not going to have in my opinion, I think that will be a headwind for economic growth as all the industries adjust around that. And it is going to cause banks to tighten their lending criteria, which in and of itself is a big form of quasi-quantitative
Lisa, you see this in
tightening.
car loans right now. I mean, I'm reading about it percolating in. You can't go out, this is a general statement, you can't go out and get an auto loan now because they're tightening up.
Yeah, I think there was something like the lending that a lot of them have been rejected, Tom.
But don't remember, too, we just came through a period where zero interest rates was the rocket fuel for shadow banking. So, and now we're gonna dial that back somewhat, too, in my opinion, which will be an effect for slower growth.
There's a confluence of a lot of different factors here, and teasing out all of the different interconnected pieces can be tough. I want to go back to something that you said, that we're still about 10% elevated when it comes to the deposits, the cash sort of awash in the banking system, and you talked about how that's going to get withdrawn and that's going to have a sort of accelerating tightening feature to the economy. Is that deposit base going to disproportionately leave those regional banks? In other words, it might be 10% of overall deposits, but a much greater portion of just the specific smaller and mid-sized banks, given the consolidation of deposits in some of the big behemoths?
It actually was going to leave the bigger banks more because they're bigger. So, for example, our estimate is roughly $60 billion, I think we were going to see come out of J.P. Morgan this quarter. And now it'll be less because of this remixing. But even Jamie Dimon's been in his calls talking about the fact that he saw hundreds of billions of dollars of shrinkage in his deposits. But I don't want to alarm anybody by that because the industry has been planning for that and knew that that was going to happen. And remember, when we talk about it, what is that? Well, that's the Fed shrinking the money supply. It's also depositors buying treasury bonds because they yield more rather than bank deposits. That's cash sorting. So I think it's navigable, but if we put a crisis around it, it just makes it trickier.
Given the likely increase in flows out of some of these deposits, given commercial real estate and the stress there, given the shadow banking system and potential fractures that people are expecting there, do you think that this banking crisis is over?
I think every day that goes by, we're getting more stability. I think Washington wants it to stop. I think barring any other major shocks, I think it's behind us and that we can now deal with some of the more challenged institutions. But also, too, if we had more time and I laid out the statistics of Silicon Valley, it was off the charts on a couple of risk measures.
Yeah, no
I mean,
question.
off the charts.
Yeah.
And remember, we have 4,700 banks in the United States.
Right.
2 of them have failed spectacularly and quite large, so we're not underestimating the impact
I got
of it.
8 ways to go here. I got time for one question. Somebody emails in here, and this was an honor to play at Middlebury years ago when Wendell Forbes was coaching. When in God's name is Middlebury going D1 hockey? They were born to play D1 ECAC hockey. When does this happen? You're in charge.
Middlebury's good, and I got to tell you, now baseball's made a run at Middlebury, but when I played baseball, we got our fans when they walked past the field to go watch lacrosse. But now baseball's standing. I'm looking at
get
baseball.
all the visibility. When do you guys go D1 hockey? It was made to happen.
I would support that. We've got a great team.
There we go. That's the news we need to have today. Thomas Schott of Middlebury with the support up Route 7, and of course, a small matter at KBW, definitive on banking research. What'd you learn there from Mr. Michaud? I learned that, it's sort of like, okay, it was 2 banks and we're beyond.
There are a lot of question marks around the depth of some of the fissures, and I think that sort of the weakness in the economy is the most important point, and the fact that there is sort of a disproportionate lending from these regional banks, and this question around, well, if people do withdraw assets from them, the consequences for the economy are greater, although I do wonder whether you start to see some of these banks offer higher rates again to sort of lure in some of those deposit bases, and as people start to think about that again, if they get past it and we do get some stability.
I think what's underreported here, and I mentioned Fidelity this morning and some of the Schwab challenges, is I'm old enough, unlike young Michaud and you, I actually remember the shock of what's a money market fund? And I'm still living with that. Those things are over there, away from the land of KBW and Sandler O'Neill and the rest of them, and that money market funds had changed everything, as we all felt decades ago.
You mean because we have to actually care what they invest in to get that extra yield?
Because you look at the BTMM screen, it's a 5% yield.
All of a sudden, it means something.
Jamie Dimon's not giving me 5%. I mean,
if the Fed keeps hiking rates, how much does that ratchet up the tensions?
You should see the toasters at the National Bank of Middlebury. They're from LL Bean.
You have them lined up? Yeah.
It's like they're from LL Bean. It's like a New England thing. Coming up, David Rubenstein. Lots to talk there, including his important interview with a leader of Citigroup. Stay with us. At Futures Advance, S&P Futures up 31. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. UBS is going back to the future. Sergio Motti is returning to the bank as chief officer to oversee the acquisition of Credit Suisse. Motti will replace Ralph Hamers, who has been in charge for just over 2 years. He will retake the role he held for 9 years after the annual general meeting next week. Now, the German government will increase its financial support for Ukraine by as much as $13 billion. The money will mostly be used for weapons. Bloomberg's learned almost half the money will be available this year, more than doubling the current amount. President Joe Biden and House Speaker Kevin McCarthy exchanged dueling letters in the fight over raising the debt ceiling. McCarthy is demanding that negotiations begin on a series of spending cuts and regulatory changes. The president responded by challenging Republicans to produce a public budget plan. Mortgage rates in the U.S. fell last week to a 6-week low. According to the Mortgage Bankers Association, the contract rate on 30-year fixed mortgage declined 3 basis points to 6.45%. Meanwhile, the lower rates helped drive a 4th straight increase in applications to buy a home. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The banking system is pretty sound, and we're talking about a few banks. We heard it from the chairman, Powell, today. This is not something that is spread across the entire banking system. This isn't like it was last time. This is not a credit crisis. This is a situation where it's a few banks.
Very important to note that recorded March 22nd, the leader of Citigroup, Jane Fraser, in conversation with David Rubenstein. Look for that important in-crisis full conversation, Jane Fraser, and peer-to-peer conversations tonight at 9 p.m. For those opening in Asia, that's a big deal. Lisa, really extraordinary to see Jane Fraser speaking there versus the conversation with David Weston in Davos. It seems a million miles away.
there needs to be some sense of confidence, not just in the banking system, which the large banks are by all means very solid, but a question around the role of the big banks in supporting the smaller ones. And that's something that came to the fore over the past few weeks. Tom.
Someone who studied this, of course, is the gentleman of that interview, David Rubenstein, joining us now, co-chairman and co-founder of Carlyle Group. It's a happy David Rubenstein as he joins us today from his Duke University. Thank you, David, for joining us from Duke this morning. So much of this is a distrust of these major banks. How did Jane Fraser frame that you can trust us this time in this big crisis?
Well, for those who don't know, Jane is, it's hard to believe, but after 250 years of our country's history, she's the first woman to head a major money center bank. She's a native of Scotland, but educated here at Harvard Business School, worked her way up at Citi over many, many years, and for the last 2 years has been the CEO of the bank. Her view is that the banking system is in pretty good shape. Obviously, there are a few problem childs, and they're being dealt with, like Silicon Valley Bank, and maybe you could argue First Republic Bank. And I think what she's saying is that the banking community is coming together to figure out how to solve some of these problems and not relying only on government assistance.
We have spoken today, David Rubenstein, of say there were 3 big Swiss banks in our childhood, and now there's one, I guess. We'll see how that works out. There's also been the turmoil in American banking. Do you suggest in your conversation with Jane, and for that matter, all of your contacts, that things are being sped up now for the major banks, that they're going to have to move and act strategically faster in the coming months?
Well, in the crisis of 10 years ago or so, the major banks were, to some extent, with 1 or 2 exceptions, undercapitalized. Now the major banks are well capitalized, leaving Credit Suisse aside. They're well capitalized, and therefore they have more of a ability to help other banks. And so, as you saw in the case of First Republic, the major banks put together money that would go into First Republic as deposits, and hopefully that will shore up the situation until a more permanent resolution. But I don't think we have a crisis where J.P. Morgan or Wells Fargo or Bank of America have financial problems, or Citi, but they clearly, everybody's always nervous when there's a banking problem, but I think this one's reasonably under control.
Do you think that this is the best PR move that ever happened for big banks, because they can basically come to the rescue, be the good golden children, and all of a sudden have politicians coming out and saying, you guys should all be more like them?
Well, I'm sure that might have been in the back of their mind, but the truth is the U.S. government used to come in and kind of resolve these things, but in this case, Jamie Dimon, although he's working with Janet Yellen, has taken the lead. So you have banks putting in the money in First Republic, and that's unusual. You don't usually see that in a kind of voluntary basis, but I think it's good for the system, and it shows how supportive the major banks are of any problems that they see in the banking system.
I love that you were the one interviewing Jane Fraser, because you're 2 behemoths in the industry, 2 behemoths in the financial system that really is the focal point of so many prognostications at this point. From your vantage point and with your discussion with Jane, do you get the sense that there truly is a mass wave of credit tightening that is coming upon us that is going to really become clear in the second half of this year?
Well, interest rates have been going up steadily, as we know, this year, and as a result, there are consequences. One of them is supposed to be a slowing down of the economy and higher unemployment, but one of the other consequences, obviously, is some banks are hurt by this. The general occurrence when interest rates go up is it probably usually helps banks a bit because they can charge more than they're otherwise going to charge for loans. But in this case, what you're seeing is that some banks had a lot of securities which become worth a lot less when interest rates go up, because they had bonds or treasury bills which go down in value as interest rates go up, and that produced a credit hole, obviously, in Silicon Valley Bank, and probably in some other banks there's some modest credit holes. So raising interest rates has not been an unvarnished a good thing for the banks, though generally when interest rates go up, it's not that harmful to banks. Right now, I think the banking system is in reasonably good shape, though.
David, you grew up basic in Baltimore. There's going to be a House committee meeting today going after fat guys like you, the fat cats out there of global Wall Street. I want you to speak to House Republicans today with their immense distrust of the kind of people that blew up SVB. What do you say to people representing a broader middle class of America that say, who are these guys and why are we putting up with them?
Well, whenever somebody loses money, governments always come in and say, who's at fault? Certainly it's not the government. The government would say it's never at fault. So I'm not surprised that somebody will go after somebody that's lost money for shareholders and so forth. But as beating up on Wall Street types or finance people is a relatively common experience. I don't think people are going to be shocked by it. In the case of Silicon Valley Bank, they clearly did some things that the regulators should have been more on top of. And I think under the banking regulations and laws, the Federal Reserve Bank in San Francisco was aware of it and was working on it, but I don't think they did enough quickly enough to take care of the problem.
Oh, that's the question, David, the quickly enough of it. Can we legislate the courage to be quickly enough?
Whenever you have a financial problem and something goes wrong, you always try to have a fix. So Dodd-Frank or Sarbanes-Oxley. But the ingenuity of mankind is such that they can always figure a way around some legislative or regulatory constraint. And so I don't think we're ever in our lifetime or anybody's lifetime going to solve all these financial problems. There's always going to be somebody taking advantage of some rule. So I don't think we can fix it overnight, and we can't just point a finger at somebody and say it's your fault alone.
David Rubenstein, thank you so much from Duke University this morning. An important conversation, Mr. Rubenstein, with Jane Fraser. Peer-to-peer conversations tonight at 9 p.m. In New York. I want to mention something, Lisa, which is in the background, certainly for America today. We do this with the market up essentially 1%, some real nice things. The moment of history going on in Germany right now is absolutely jaw-dropping. It is something unimaginable over the span of 2 world wars and all of the history that we've lived and our parents lived. This is early tape of the king over the span of 2 world wars and all of the history that we've lived and our parents lived. This is early tape of the king of the United Kingdom and of Great Britain visiting the Brandenburg Gate. And you look at something, Lisa, like Gregory Peck in 12 O'Clock High, which was an iconic movie that shattered our illusions of World War II. We went in there and we had to level it within a war led by the British and the British airfields. And this is the King of England returning here before his coronation. France was a political maelstrom, and here he is in Germany being greeted by the German people. Sir Anthony Selden, who I've talked to many times, a great biographer of Tony Blair and others, and Sir Anthony, speaking to the BBC, makes clear the significance of this is once in our lifetime.
Especially at a moment of war, right? Especially at a moment where the cohesion of Germany and the UK, very much a departure from the 1940s when it was quite the opposite, comes at a time when they're trying to unify a front with a conflict that has not stopped and that continues to rage on in Ukraine. And that, I think, is really the crux of the symbolism at this moment to see King Charles in Germany.
The symbolism here, overlooking our Berlin News Bureau in Germany now, and of course the Brandenburg Gate. For those of you on radio, it is that iconic gate that means so much across so many generations and wars as well. Let us get back to what we do at Bloomberg Surveillance, which is just simply, Lisa, we greet a better tape into claims tomorrow and critical inflation data on Friday.
Lee Farage said it. At what point do we rewind 3 weeks and go back to the same playbook that we had when Jay Powell went before Congress and said they potentially 50, well, I mean, really, this is the issue for me. And I'm looking right now at Fed funds expectations, and they're creeping up in terms of where they're going to end the year. Basically, people saying, well, if things are looking good and it's crisis averted, then why are we suddenly on the verge of Armageddon that's going to naturally disinflate everything?
Oh, look at that. I missed this, folks. Just in the last hour, the 2-year yield explodes. That's the right word. To round it up, 4.12% in the 2-year yield. That's out above new highs early this morning. Please stay with us through the day, including David Rubenstein's important interview with Jane Fraser. Bill Isaac, former FDIC chairman, later. This is Bloomberg. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
So can you talk to us maybe about like how important data targeting or targeting of an audience actually is? Because I think we hear these things like, oh, it makes it harder for advertisers if they're not able to track your data. Why is that so important? And like, can you maybe give us some numbers around how valuable a targeted ad is versus an untargeted one? I don't even know if untargeted ads exist on the internet.
Oh, yeah. Well, and just on to sort of add on to Tracy's question, like, let's say I go to golf.com. Yeah. Okay. The ads that I get, like, how much is it? Oh, he's on golf.com. He probably wants to read about golf, as opposed to ads that I get that maybe, you know, the last 10 sites I went to is like pets.com or something like that. Yeah. And so how valuable is it for golf.com to be able to know that I also like pets?
I mean, there's all sorts of open and unsolved questions about the value and precision of online advertising. The classic example is like you go and you buy a pair of sneakers and then all you see are ads for the same exact sneakers, like just following you around the internet, right? It's like, I just bought these. Why do you, like the world's biggest tech companies that so supposedly know a lot about you, like can't solve that problem.
You bought one pair of sneakers.
Yeah,
you must
you
want
might want
more.
another one, right?
Well, I do, but I definitely don't need a second stove.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Looking pretty good this Wednesday morning. Good morning, good morning. From New York City, equity futures higher by 0.9%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, President Biden says the banking crisis is calming down. It's day 2 for financial regulators up on Capitol Hill. And over at UBS, Hammers is out and Motti is back in. We begin with the big issue, more questions than answers.
We're left with many questions.
I got a lot of questions.
The Fed had plenty of authority to prevent Silicon Valley Bank.
It looks to me like the regulators knew the problem, but nobody dropped the hammer.
What I worry about is the fundamental unfairness here.
You're asking important questions.
I also think you raise important questions. If you had stress tested Silicon Valley Bank, it wouldn't have made any difference, would it? I don't know the answer to that question. You stress tested for the wrong thing. These decisions were made before I arrived, but I agree with you that it's like somebody going in for a test for COVID and getting a test for cholera.
The bank executives lost their jobs, as should some of these regulators. Shouldn't that be the case if they're asleep at the wheel?
I want to be very careful. There are laws and procedure. I don't have a definitive answer for you at this moment.
The team coverage begins right now with Bloomberg's Anne-Marie Horton down on Capitol Hill, Katanga Johnson in Washington. Katanga, first to you. We've had day 1. What are you looking for from day 2?
Today, we really do expect lawmakers in the House to really drill down on two main themes. On the one hand, lawmakers will be curious about whether the FDIC acted quickly enough in the process of trying to find a bidder for Silicon Valley Bank, as well as focusing on the Fed's role in really using all of their authorities to prevent this issue, and whether the agency knew soon enough sort of how bad things were at Silicon Valley.
AMH, you saw what the president had to say about the current crisis. I think we've done what we need to do executively. I feel confident that things are settling out. The markets seem to be responding. I'm not sure whether we'll get much legislative change. On the policy front, Anne-Marie, just where are we now?
Well, Jonathan, what we hear from lawmakers that they want all the details first and foremost. And when it comes to policy, it's going to be very difficult for a divided Congress to change really any policy unless it's the FDIC limit. This really seems to be the one issue on Capitol Hill that lawmakers, either Republican or Democrat, are actually looking into. Do you need to raise this insurance cap? But if you're looking at regulation, what the Biden administration would like to maybe see a rollback of 2018 of Dodd-Frank that many lawmakers, the most likely you'd think of Senator Elizabeth Warren, who yesterday asked all the officials in the room and the regulators in the room, should there be more regulation? They all said yes. That kind of legislation, Jonathan, that is not going to happen on Capitol Hill, not in this Congress.
And not the only development in the last 24 hours. Also, Anne-Marie, this morning from the Senate Finance Committee chairman on Credit Suisse. AMH, this quote from them is brutal. At the center of this investigation are greedy Swiss bankers and catnapping government regulators, and the result appears to be a massive ongoing conspiracy to help ultra-wealthy U.S. citizens to evade taxes and rip off their fellow Americans. What do you make of the language, the allegations that came from that individual and the committee chairman earlier on?
Yeah, Senator Wyden this morning when that report came out, Jonathan, this really blistering attack of Credit Suisse, which obviously you know better than anyone else, has had their own issues, and they've now been dissolved within UBS. This is a moment, really, and you're going to see a lot of attacks against banks in general going into the 2024 election. They're pointing the finger that some of these banks are helping wealthy Americans not pay their taxes. And remember, it's Democrats that really wanted to put money into the IRS so they could go after what they would call tax cheats.
AMH, Katanga, to the both of you, wonderful as always, the team coverage down on the ground on Capitol Hill. Day 2, day 1 was in front of the Senate, day 2 is in front of the House. I want to start with this quote. It comes from Neil Dutter of Renaissance Macro. Pick your battles with the consensus wisely. There is no middle ground in a banking crisis. It either happens or it doesn't. This means the bond market is either pricing in too many rate cuts or not enough. Priya Misra, Samir Samana, join us right now. Priya Misra, I want to come to you on that. Neil Dutter's language. The bond market is either pricing in too many rate cuts or not enough. Priya, which one is it?
I think the market is actually pricing in both, right? The market has to price in weighted average probability of outcomes. I do struggle with the average pricing here because the market's saying the first 25 basis point rate cut happens in September, but then the Fed only cuts, 175 basis points. I think if we're looking at a hard landing, we're in the hard landing camp. The Fed's going to cut much more than that 200 basis point that's priced in. But our view is that the Fed starts those cuts much later. So they start later this year and then they cut a lot more. But I think the market's pricing in, I would call it a sort of bimodal distribution. There's a view that this blows over and there's no lasting impact of the bank crisis. And so the Fed gets rates to 5% and then very slowly, according to the dot plot, cuts rates to 3%, over the next couple of years. And then there's this view that there's going to be a hard landing. There's much more to come here. And therefore, the Fed will have to cut more. I think we don't know. There's high uncertainty. That's why the bond market's moving 25, 30 basis points every day. The market's pricing in this weighted average probability. And those probabilities change, every day or multiple times a day. So we are pricing in sort of both these outcomes.
Samir, what's your take on this?
Yeah, look, the market's just pricing in too many cuts. Again, not to take anything away from what's happening, but I think to I guess maybe define it as a banking crisis is maybe the wrong way to look at it. I think probably the right way to look at it is a lot of people got caught on the wrong side of long duration, and that's really what's going on here, right? When you look at a lot of non-earning growth companies last year, which happen to be the clients of a lot of these banks, which happen to want their money all at the same time, I think you have to look at it through that lens. They also happen to have too many securities that were long duration on their balance sheets, so that didn't help. And I think, this is probably the start of kind of the recognition that much of this year will be spent in kind of this rolling credit crunch. And a lot of this can be kind of tracked back to the Fed is raising interest rates. And for the longest time, a lot of people looked past that, almost dismissive of those rate hikes. And I think what we would remind people is, look, it's been only about a year since the Fed started raising rates, and this is kind of when those long and variable lags start to kick in. So in our minds, this is kind of the start of the process, but it also shouldn't lead to rate cuts later this year.
One feature of this conversation on this program over the last couple of weeks is the idea of data dependency, Priya. And I've asked it a few times, dependent on what data. This is what the calendar looks like now. Payrolls on the 7th of April. On the 12th, we get CPI. I hear nobody talking about those two data points. I hear them talking about banks, earnings from First Republic on the 13th, JP Morgan on the 14th. I hear them talking about the Senior Loan Officer Opinion Survey as well. Priya, what is the data, the incoming information that's going to reshape this rate story at the Federal Reserve?
Sure. So I think, every data is important, but I would say the data you talked about, whether it's payrolls or CPI, it's going to be a lot less important because it's picking up credit conditions 6 months prior. It's actually even picking up monetary policy, I would argue, 6 to 9 months earlier. So the data we'll be watching will be, what happens. I still think of this banking crisis as a liquidity crisis morphing into a capital crisis. What happens on the liquidity front? Are banks having to rely on either home loan or the Fed facilities? In which case, this becomes more of a capital crunch. And then ultimately, lending standards worsen. Is that going to impact loan growth, going forward? How do financial conditions evolve? We'll be looking at still, I think, bank economic data, if you may, or the data around the banking system, I think will be far more important because I don't think that we can, go back to where we were 3 weeks ago. I mean, whether you talk about regulation, you were just talking about that, whether that comes out of this or the banks themselves become more risk averse. I think we'll be watching banks because the data right now is not reflecting the banking crisis. I think it's going to be at least a few months before the data starts to reflect this. The Fed's supposed to be forward looking, and we know markets are certainly forward looking. So I think we'll be watching the banks much more than actual economic data.
So in the near term, May 3rd is the next meeting at the Federal Reserve. Samir, do you think they will have is it reasonable to expect them to have sufficient information to make a rate call by then?
Yeah, I mean, look, going back to the previous question about, what are they going to be looking at? I think it's going to be a combination of both kind of inflation and unemployment and also, kind of what's going on with credit conditions. I mean, at the end of the day, as much as we would like for the Fed's mandate to be leading credit, it's really unemployment and it's inflation, right? Two of the most lagging variables. That is their mandate, whether we like it or not. And so if inflation starts to tick back up, if wages start to tick back up, if the labor market remains incredibly strong, does the Fed say, we're going to kind of pause here just to kind of see how things play out? I think that's pretty unlikely. They have to kind of withhold, kind of the line on kind of their mandate because, look, if you give these markets time, they will heal and pretty soon we'll have inflation kind of rearing back up. I mean, look at what's happening with oil and the energy markets.
Samir, stick with us alongside Priya Misra as well. Your equity market up 0.9% on the S&P. We'll continue that conversation. Mike McKee's going to join us in a moment as well. I want to get you some movers. Here's Katie Greifeld. Hey, Katie.
Hey, John. Well, let's start with the big news out of Europe, and let's start with UBS. Sergio Ermotti, he's going to be back in the saddle as UBS CEO. He's going to take over on April 5th to oversee the Credit Suisse acquisition. Ermotti, obviously well acquainted with UBS and Swiss banking, given that he spent 9 years in the CEO seat. You can see that UBS shares higher by about 3.5% at this moment. And sticking with CEO shakeups, Macy's also came out this morning and announced that CEO Tony Gannett will retire in February 2024 and hand the reins over to Tony Spring. He is the current CEO of Bloomingdale's. Macy's down a little bit on the news, just 0.5%. And on the earnings front, we had two big names report after the bell last night. Lululemon up 16% pre-market after issuing a beat and raise report. Adjusted EPS beat estimates. Annual sales outlook surpassed expectation. And Micron also rallying pre-market. John, there was a lot of concern about the demand picture for memory chips, but the sales outlook suggests that maybe the worst is over.
Katie, thanks for that. We'll catch up with you around the opening bell. Coming up, a banking issue is a substitute for rate hikes.
This was ripple number one, and we don't know what it's going to cause. We know the government can help us backstop the deposit base, but we don't know what ripple number two is. I don't think the Fed sees them having a policy conflict, but the market certainly does.
That conversation up next.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
The risk has gone higher, for sure. They don't know what the impact of all this hiking and the banking liquidity squeeze is really done. And the truth is, I don't think it's increased the risk of inflation, right? It slowed down the economy. It will slow down lending. It will slow down inflation. Does that mean if the inflation is dead? We're not going to know for a long time. But the risk of disinflation and the risk of a bust is definitely higher.
A whole host of Fed speakers returning to the spotlight after a heated few weeks on Capitol Hill. Barkin, Collins, Kashgari, Williams, Cook and Waller all on deck this week, facing a market with nearly 100 basis points of rate cuts already priced in by year end. The argument's simple. The banking crisis will do most of the work for them. The St. Louis Fed President Jim Bullard weighed in on some of this. He said continued appropriate macroprudential policy can contain financial stress in the current environment, while appropriate monetary policy can continue to put downward pressure on inflation. Mike McKee joins us right now. And Mike McKee, I guess the question is whether you can deal with both these issues separately.
Yeah, that is the question going forward, and it'll be interesting to hear from the rest of the Fed officials. Right now, it looks like they are dealing with inflation. You take a look at what's been happening in the economy. It has been slowing. The Red Book retail sales numbers that come across on a weekly basis show a decline in year-over-year activity at the same time that PCE inflation is going down. Now, we'll catch up with the PCE. These are February numbers on Friday when we get the latest update. But as Priya said earlier on the show, these are backward-looking data. So what are we going to look at more forward-looking? We can't get anything that's actually going to tell us the future, but the most immediate things in the background are things like this, the St. Louis Financial Stress Index, which does show the greatest amount of stress in the financial sector over the past couple of weeks since the pandemic and before that, the great financial crisis. Now, these numbers only go through the 15th. So we'll be waiting today at the end of the day to get an update on whether financial stress has come down or not. And then you have the question of what's happening with banks. And as Neil Dunham was saying, and you quoted him, it's either a bank crisis or it's not. Right now, so far, it's not. We're looking at lending there from all banks and from small banks. And as you can see, not only have they held up, but last week they rose. So we'll see if that continues this week when we get the data on that at about 4:15 on Friday. We'll see what's happening with the banks, and we will see if we are having a crisis or not. So the Fed speak is going to have to depend on reading the tea leaves of these more coincident indicators than on looking backwards at things like PCE on Friday, as important as that'll be to traders.
Mike, you and I have talked a lot about whether policy is truly in conflict. I think a lot of people have written about that over the last couple of weeks. Seth Carpenter at Morgan Stanley totally disagrees. Mike, you wrote this over the weekend. Central banks are deliberately tightening financial conditions in order to slow their respective economies and thereby bring inflation down. What the bank's disruption does, however, is make it harder to calibrate the correct degree of tightening. So, Mike, it's not that policy is in conflict per se. It just makes the calibration of policy more difficult. Do you have sympathy with that view?
Absolutely, and that is something that Jay Powell talked about in his news conference, and the Fed officials have been talking about since, that they know that bank lending may tighten because of the bank issues, but they don't know by how much, and the estimates from Wall Street firms are all over the lot, from 0.3% to 1.5%. So at this point, they kind of have to watch and see, and that's why it's going to be a game time decision for them next time on rates, because they aren't going to have a really clear picture of how much tightening there's going to be of credit and how that's going to affect lending.
Not by early May, not based on what we've seen so far. Mike, thanks for that. Mike McKee, thank you. Priya Misra, I wanted to come to you on that. I'll read that quote again from Seth Carpenter at Morgan Stanley. Central banks are deliberately tightening financial conditions in order to slow their respective economies and bring inflation down. What the bank's disruption does, however, is make it harder to calibrate the correct degree of tightening. Now, just 3 weeks ago, Priya, we were talking about no landing, maybe opening the door to 50 basis points, maybe having a look at 6% on Fed funds. Just 3 weeks ago. Now, Priya, who is to say we won't be back at that point in another 2-3 weeks' time if this banking crisis fades?
So I think it's interesting. You say fade. So maybe some of the financial stress issues, the liquidity crisis, the bank runs, that can stop. Will the capital issues that the U.S. banking system faced, does that go away? And I would argue it doesn't. I think you've opened a Pandora's box. There are massive unrealized losses sitting on bank balance sheets. If banks are having to pay up for deposits, that net interest margin is going to be under pressure. So I think we have to recognize that the banking system is going to have to delever. Either they're going to have to shed assets or raise capital or some combination of both. And that's going to impact lending standards. You know, I think it is going to have an impact on the economy, but when and where does it show up? I don't think it shows up in the labor market, may not show up in inflation for a while. So I think what we have to get used to will be a Fed that's going to sound a little tone deaf, because they're going to look at their dual mandate. They're going to potentially hike in May. They might pause, but I think to justify these rate cuts, you have to see the tightening in lending standards show up in the data. And I think the Fed is in a very different position now than they were during COVID or during 2008, where they had the luxury to be preemptive. They don't have that luxury. So, you know, I think things can absolutely fade. The sentiment in the market can improve. But if lending standards tighten at the same time as that savings buffer, the consumer savings buffer that we've talked about so many times, that has provided that cushion to the consumer, that savings buffer is running down. This is exactly when the banks should be making loans. And if the banks are actually stepping back, I think it adds to the monetary tightening. So I think the market is doing a lot of that work for the Fed. But the Fed is looking at data that is not going to show that. So I think they can pause. They can absolutely pause after 1 or 2 more hikes. But I think then the market will have to get used to a Fed that's not being responsive enough. And that's why I think owning the front end to me looks risky, because it's a view on, you know, when does the Fed start to cut? Own the long end, because this is absolutely going to result in a hard landing. It's just when that happens and when can the Fed respond. I think that is extremely difficult to sort of, you know, calibrate, to use Seth's words.
You mentioned that word when a few times, so let's talk about the when. Andrew Hollenhorst of Citi addressed some of this. His view: we do not think that the disinflationary or deflationary impact from slowing lending and weaker growth would come into effect until 2024. Samir, when you think about the when of this, you think in 2024?
I mean, look, we think there's a moderate recession in the very back part of this year, and inflation probably doesn't meaningfully come down to the Fed's, you know, kind of 2% target probably until next year, you know, setting the rate, you know, the stage for rate cuts, you know, again, probably early part of next year. What's really interesting is, so the same market that's pricing in rate cuts now has 1-year inflation break-evens at 3. So, you know, kind of riddle me this, Batman, right? Yeah. I mean, how can you have 3% inflation a year from now with the Fed cutting rates aggressively in the back part of this year? It's just not going to happen. So either one of the two things needs to be reconciled. Either you can have a very tough recession in the latter part of this year, which gets inflation down to 2% and the Fed cuts, or inflation still is kind of middling in that 2, 3, 4% at the end of the year, and the Fed is still at 5%. I think we're probably in the latter camp. We think markets are range bound, you know, with probably a little bit of a skew to the downside. But, you know, that's going to be the real exercise for investors this year, is they're going to want to try to push things both to the up and the downside. And what's really going to happen is we're probably not going to make a lot of headway between now and year end.
So, Samir, those 2 points, okay? Option number one was disinflationary bust. Option number 2 was inflation stays too high and the Fed stays at 5%. Now, you're leaning towards the latter, Samir. Talk to me about the capital allocation decisions you'd made with that in mind.
So you play defense. We're playing defense on the fixed income side, and we're playing defense on the equity side. So overall, we've got a little bit of money from equities into fixed income, but then within stocks, we like large, we like mid, we don't like EM, we don't like smalls, we don't like developed. On the sector side, we like energy, healthcare, tech. We think all of those have some durable demand for their products and services. We don't like consumer discretionary. We don't like real estate. We think both of those are weak points in the economy. And then on the fixed income side, we like a barbell. We like the short and the long end parts of the curve, and we would continue to fade credit until we get paid to take that risk.
But Samir, you like US, right? US over the rest of the world, even though that the epicenter of risk right now is right here?
Yeah, I mean, look, if you look at the S&P, it's almost 60-65% growth areas like healthcare, like technology, like consumer discretionary, at least, kind of the more growth-oriented parts, the comm services parts. If you look at financials, really you don't even get to a bank in the top, holding, right? It's really kind of a financial conglomerate. So I think you've got to look at kind of composition. It really matters in this kind of market.
Samir, smart, as always. Samir Samana there, Priya Misra to the both of you. Brilliant. Thank you. Thank you very much. Equities right now at 1%. Just a range of views. You take your pick. I'm not here to make a judgment. Coming up, the morning calls, and later, the case for energy stocks. Why Alpine, Sarah Hunt sees opportunity in recent weakness. That conversation happening around the opening bell. About 7 minutes away.
For parents and anyone out there who still doesn't quite understand, what exactly are kids doing on Roblox?
Kids on Roblox aren't just playing, they're learning, they're hanging out together. When they can't be together in real life, they're hanging out on Roblox. They could be playing hide and go seek. They could be pretending they're running a store or a pizza parlor. They could be making the next big game or adventure. So it's really a wide range of things, and it involves doing things together, pretending you're together.
Everybody is talking about the metaverse as something that's going to happen in the future, but there's an argument to be made that Roblox has already built a metaverse. What do you think?
I think we've started. There's still so much innovation to be done, and there's so much invention to be done in this category that it's mind-boggling.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Said this a few times already this morning. In that kind of market where no news is good news and no news on a banking crisis, I guess, is good news. Equities up by more than 1% on the S&P. On the Nasdaq, similar move. On the Russell, similar move, with that heavy weighting on the Russell towards the financials. That's the price action. Let's get you some morning calls. First up, Morgan Stanley downgrading Ciena to equal weight, seeing limited expansion this year due to weaker demand. That stock's down 2%. Gordon Haskett downgrading Macy's to a hold, saying recent data revealed softening trends in foot traffic and digital visits. That stock down by only 0.6%. And finally, Susquehanna upgrading Carnival Cruise to positive, expecting a strong travel season this summer after earnings topped estimates. That stock up by 2.9%. Coming up next, Alpine Sarah Hunt seeing opportunities in beaten down energy stocks. That conversation around the opening bell.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Three seconds away from the opening bow this morning. Good morning. Equities doing okay, up by 1% on the S&P. On the Nasdaq, up by 1.2%. Will it stick? And can the S&P 500 break away from 4K in a big way? Over the last few months, going back to November, just in and around 4,000. 5% up, 5% down, but can't get away from it. That's your opening bow. Switch on the board and get to the bond market. Yields look like this, higher by 2 basis points. Let's call it 360 on a 10-year, 359.43. In the FX market, euro dollar 108.36, negative 0.1%, and crude back nicely in the 70s over the last week or so, up 1%, 73.99 on WTI, just short of 74. About 20 seconds into the session, your equity market shaping up as follows. A lift up 0.9% on the S&P. We had some weight back into the Nasdaq, up more than 1% on the Nasdaq right now. What stock to watch at the open? Micron. Shares moving higher after issuing a better than expected outlook. The CEO saying this: customer inventories are getting better, and we expect gradual improvements to the industry supply-demand balance. Ed Ludlow on a story. Morning, Ed.
Yeah, good morning, Jonathan. That statement and also the forecast for the fiscal third quarter of sales at $3.9 billion above street expectations is being taken by the market and a number of sell-side analysts to mean that the down cycle we have seen in memory-related chips may be nearing a bottom. Remember, Micron does not have a very diversified business. It's the biggest maker in the US of memory chips, but it competes with Samsung, SK Hynix, in an industry that has really seen its end market slow down. We're talking smartphone handsets. They do have some offerings when it comes to data centers. That market for data center memory bottomed in the fiscal second quarter, the quarter just gone, according to Micron. This terminal chart, though, is critically important. It tells the story. The loss that's expected in 2023 is the widest, the biggest deficit for Micron, going all the way back to 1984 when they first went public. The story of the last 12 months is that this has returned to a cyclical industry, boom and bust. There has been bust when it comes to memory chip. What we're seeing is that actually, instead of making new orders, smartphone companies and other device makers have been working through their inventories and backlog. That's what we're talking about here from the CEO. That situation's improving, and I think what we see is the upcycle potentially starting in the second half of this year. We're trailing the Philadelphia Semiconductor Index on a 12-month basis and also a year-to-date basis, but looking on the gains at Micron, we're now up more than 4%, closing that gap in performance terms.
A nice move there this morning. Ed, thanks for that. Bigger move here. Lululemon absolutely flying, overcoming its own inventory issues and delivering an upbeat forecast. The CFO had this to say: looking ahead, we remain optimistic regarding our ability to deliver sustained growth and long-term value for our stakeholders. Katie, that stock up more than 12%.
absolutely surging. And all of that is just a fancy way to say that leggings are in high demand right now. Athleisure, super hot. That's what we heard from Lululemon last night. And that gain that you're looking at, 13% as the bell rings, that is the biggest gain in 3 years if it holds. And that all comes down to the outlook that this company delivered last night. The headline figures topped estimate. Lululemon sees revenue at $9.36 billion. Analysts had been looking for $9.1 billion. Adjusted EPS guidance also beat. It's seen at $11.61. That's about 32 cents higher than the estimates. Sales growth, meanwhile, that measure is actually seen slowing. Sales are expected to rise about 12% in fiscal 24, 14% in fiscal 25. That's still double-digit growth, though, John, and shareholders seem to like it.
I don't like that Midtown uniform. You know that the guys are wearing with the Lululemon pants? Do you know that one?
I'm well acquainted with it. I got to say, it's all about the range of motion.
Yeah, not a fan. Not a fan. Katie, thank you for that, as always. The stock's flying. It's doing nicely, up by 14%. Close here could be one of the biggest day of gains we see for that name, going back to spring 2020, and that's when fashion just collapsed. You remember. The team at Jefferies throwing some cold water on the retailers, saying this: maintaining their underperform rating, better 4Q and better outlook, but our concerns haven't gone away. We remain guarded as competition rises and the consumer environment slows further. That's the latest from them on that name. Elsewhere, UBS have this to say: Hammers is out, Amati back in.
I'm fully aware that we need to work very hard here to avoid any consequences for the taxpayers in Switzerland. So I think you have my word and commitment that I, together with my team, we will work and do everything that it takes to make this transaction successful.
Marion Hoftemeier joins us now from Zurich. Marion, big news, Amati's back.
Definitely. So it's a ghost from the past for UBS. You know, he was the former CEO of UBS and led really that bank to a stability, to the behemoth that it is today and the stable bank that it is today post the financial crisis. And now they've said, you know what, he's the best horse we have in the book to help us through this transition of really taking in Credit Suisse and sorting through this very complicated integration that will take a number of years to complete.
You might have to deal with some Credit Suisse regulatory issues as well, maybe even some fines. Marion, I was just wondering what your thoughts were on that statement that came from the Senate Finance Committee Chairman, Ron Wyden, a little bit early this morning, and I can share the quote with you. At the center of this investigation, greedy Swiss bankers and catnapping government regulators, and the result appears to be massively ongoing conspiracy to help ultra-wealthy US citizens to evade taxes and rip off their fellow Americans. What's Switzerland make of that comment this morning?
This isn't an entirely new comment, right? I mean, Switzerland has had to deal with the tax evasion issue for a long time, and there were a lot of settlements back in 2014, 2015 with Swiss private banks. So, you know, it's unfortunate timing for this acquisition, and it will be something that UBS will have to deal with both from its own perspective if it's involved, but also from Credit Suisse's perspective, and the landscape itself is now being questioned. Okay, you know, are they doing things they shouldn't be doing?
Marion Hoftemeier, thank you on the latest over at UBS, and this is exactly why UBS, I imagine, pushed for that government guarantee a couple of weekends ago, just in case there was a big fine coming because you inherit problems from the likes of Credit Suisse. We mentioned this a few times over the last couple of weeks. Clearly, the regulators and officials have learned their lessons from 2008 and the financial crisis based on the actions we've seen over the last couple of weekends. We've also said, clearly the banks have learned their lessons as well, based on what happened with some banks, I'm thinking of JP Morgan, helping out others in the financial system, and then inheriting their legal issues on top of all of that, which is why perhaps UBS pushed for that financial guarantee. Sarah Hunt of Alpine Saxon Wood seeing opportunities elsewhere in energy. Energy stocks have been weak due to lower commodity prices and fears of recession. We think there is an opportunity there. Sarah joins us right now. Sarah, if people think we're facing a disinflationary bust, why do I want to be in energy?
I don't think that you need to rush into energy. I think that you have time, but I also think that there's a bit of complacency going on now that we've had a warm winter in Europe, and we've seen, you know, the question of what's going to happen with China, whether or not we're going to get a recession in the U.S. That's all been weighing on commodity prices. But I think that you will have some issues as we get into the summer if we have a very hot summer, because there is a weather component to energy. But I also think that you've got, you know, as I've said earlier, years of underinvestment in energy and positional energy. And I think that there are both interesting opportunities on the on the more traditional energy side, like a Devon, and I also think that something like a Chart Industries that plays into LNG is also a very interesting situation where it sits right now.
Sarah, do you think we are facing a disinflationary bust? Is that your underlying assumption here?
I think there's so much right now that depends on what happens with the economy. And there are so many, it's such a wide sort of probability curve right now, because it's really hard to figure out, are we completely done with this banking crisis? If so, that would be an unusual, very short version of what could go wrong when you have a massive change in interest rates. Do we have a slowdown economically across the world? Does the U.S. slow down? Does China come out of this faster? I think the U.S. is still experiencing a lot of economic prosperity on the back of 2 years of sitting at home and not doing anything. So I think that there is a very uneven recovery in this economy, so it's very difficult to parse out exactly how this goes forward. I think it's difficult, however, not to assume that some of this credit tightening that's going to come about because of the banking issues is not going to slow the economy. The question is, how slow does it get?
So, Sarah, the other question then is, where do I want to take cyclical risk? Some people are just going into tech. Lower rates, a rate cut away from another tech boom. We've all heard the same thing, Sarah. Are we underestimating the cyclicality in that sector?
I think that you had such an overreaction to higher interest rates in some of the larger tech stocks where there still is going to be growth that didn't really need to have lower interest rates in the way that people sort of expected. So I'm not sure where that goes, but I definitely think that there's growth in the tech sector. So you're going to see people going back in there, as you've already seen. I mean, the best performance so far this year has not been in the cyclical sectors or the economically sensitive sectors. It's really been in the tech sector. Even as interest rates started to go higher, there was sort of a snapback from last year because those stocks were down so much. And I think that it's more likely that the Fed pauses than turns into an abrupt cycle of cutting rates unless there's much more stress in the economy. So I don't think that we want to see the Fed cutting rates because I don't think we want to see the stress in the economy that would force that.
This is something Wei Li of BlackRock said as well, Sarah. I'd love your response to that. Just a number of weeks ago, I'm not talking months, years, I'm talking about a couple of weeks ago, there was still this belief that the Fed put was gone, that the regime had changed. Wei Li of BlackRock said this: we don't see rate cuts this year. That's the old playbook when central banks would rush to rescue the economy as recession hit. Do you take that side of things? Does that resonate with you?
Well, I think if you just look at what happened in the last couple of weeks with the banking crisis that we had in March, the ECB hiked rates 50 basis points. The Fed did not pause completely. There was some thought about hiking 50 basis points before we got through that banking crisis. But the fact that they raised 25 basis points also says that they are really worried about inflation. And I think the historical playbook in the last decade has been there's no inflation to worry about, so we can do whatever we need to with rates to make sure that we stimulate that economy. We're in a much different situation now, and the tensions are much stronger between I want to cut rates because I see things, going apart in the financial world versus I've got this inflation issue on the other hand. I think it's going to be very difficult, and I think you're also starting to see the slowdown that's coming from high rates in things like auto loan, people being accepted for auto loans and things along those lines. I think that is just starting to happen. And so I don't, it's not so easy to turn around and cut rates here with the backdrop the way it is.
Sarah, I want to finish on the market at the index level. The S&P at 1%, just north of 4K. Sarah, you can take that chart back to November. This index on the S&P 500, one way or the other, has struggled to get away from 4,000, Sarah. What is it about this level?
I mean, you could talk about the psychological level of round numbers, right? 4,000 is a flat number, and it didn't go to, it's been stuck in a range. But I think that just talks about the uncertainty that we have right now, both on the economic side and on the financial side. First, you had, rates going higher and people were piling money into bonds and treasury bonds. And then the incredible drop of treasury bonds, like look at the 2-year that went from 5% to 3.5% in basically 5 days. I think that also sort of pulls money, put money back into things like money market funds as people wait for the stock market to go higher. I think that we're just experiencing some real uncertainty on both the financial level, the economic level, and I think that is translating into a market that really is kind of stuck in between. Are things going to get better or are things going to get worse? And I don't think we know the outcome to that right now.
Sarah, the range on this 2-year this month, unreal. Sarah Hunt of Alpine, thank you, as always. The range on this 2-year this month, 5.08% intraday high, 5.08, 355 intraday low, and a couple of weeks separate the intraday high and the intraday low of 5.08% and 355, all at the front end. Right now, let's call it 4.1% on the 2-year. Coming up, the debt ceiling fight heats up in Washington.
I don't know what we're going to meet on. The deal was we each put down our budget.
That conversation up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The top names in climate change are on Bloomberg.
Think about Ukraine right now and Putin's threats to use nuclear weapons, and think about Kim Jong-un just firing all these missiles. And ask yourself, what's the percentage that we're going to have a nuclear war? I think it's in the low single digits. What are the odds that this planet is going to just rebel against what we're doing to it, and the capacity to have food production in Africa, the capacity for water where it is today? That's 100%, folks, not 1, 10, 15, 20, 50. It's 100% certain that these terrible things are going to happen if we don't do X, Y, and Z. So are we going to get serious or aren't we? We have to start to declare war on the climate crisis, coordinate as if we were in a war, get countries together to help with supply chains. This issue is existential. You know, there's this downside of where we are, but there's also this incredible upside filled with possibilities. The capital markets are already moving in this direction. People are chasing fusion. They're chasing green, blue hydrogen. They're chasing battery storage, water storage, carbon capture, utilization. Something's going to break through, because that is what we human beings do.
Nobody covers climate change like Bloomberg, your global business authority.
MAGA House Republicans want to add over $3 trillion to the debt. They've even suggested they won't release a budget so they can hide how much of their deep and harmful program cuts are just paying for their tax cuts.
President Biden and Speaker McCarthy locked in a duel over the debt ceiling. McCarthy sending a letter to the president demanding they begin negotiations on spending cuts and regulatory changes. Biden pushing back with a letter of his own, challenging Republicans to produce a public budget plan first. AMH down in D.C. Anne-Marie, lots of noise, little change.
Yeah, John, what you're seeing right now is that these two parties are really just digging their heels in for this standoff. And it comes as we were just getting ever so close to reaching that debt ceiling, the X date. Secretary Yellen had said, look out for June. A lot of people are talking about July or August. But the fact of the matter is you have these dueling letters, and what the president responded to Speaker McCarthy, who, by the way, the speaker told the president he needs to start rolling up his sleeves and getting to work in a discussion, is that the Republicans need to put a public budget plan first so that all of Americans see what they want to do. And he wants them to do before they leave for a 2-week recess for Easter. The president, though, didn't say he would not meet Speaker McCarthy. And besides the letter, when he was boarding Air Force One yesterday, he told reporters, I just don't see the point of sitting down with them yet. What is there to discuss? So the White House is once again putting it back in the House GOP hands.
So, AMH, in the meantime, we're all talking about the same thing, which is the X date. I speak to people on Wall Street, as you know. They're not taking this seriously until we get close to that. I'll ask them a question. They'll give me the same response. Where is that X date?
Yeah, we don't know the precise X date, but everyone's talking about the summer where this could really come to a brink. And I think now this is why the financial markets aren't freaking out just yet. But when they do, potentially it's the financial markets that are going to be the ones to push Republicans and Democrats to get on a same page and make sure that they can raise the debt limit. Jonathan, when you talk to a lot of people, they talk about 2011. They had the votes, and yet still the U.S. was downgraded, and that's because the financial markets took notice and there was a bit of panic.
So you're on Capitol Hill today. We had day one of the hearings yesterday. We've got day two in front of the House today. Anne-Marie, I noticed two distinct arguments, and maybe it's a bit of both at the same time for some people, but one, do we need more regulation? People think we do, of the banks. And two, did we just have a lack of enforcement of existing regulation, given what they knew, when they knew it, and didn't do anything about it?
Yeah, these are 2 points that you're likely going to hear brought up again today. When it comes to new regulation, this is something that Democrats really want to push. You also heard from Michael Barr, the Fed Vice Chair of Supervision, saying that they may themselves boost the capital liquidity requirements for banks worth about $100 billion or so. But then when it comes to what did they know and potentially just not executed on, this is where Senator Tester really made a point. He said, it sounds like you knew there was a problem, but no one brought the hammer down. And Michael Barr said that there was warnings there about SVB, the fact that they didn't hedge against their short-term paper in this higher interest rate environment. So you're going to hear a lot of that, Jonathan, today, but you're also going to hear a lot of partisan voices as well. Today, expect Republicans to go after quote-unquote woke banks, that they were too focused on ESG. And for Democrats, it's really going to be about the fact that there's this loosening of regulation, and they want to see more regulation put on these mid-sized banks.
The guy we're not talking about is the Fed chair, Jay Powell. And at what point the Board of Governors knew about all of this stuff, Anne-Marie? When did it hit his desk? Did we get much clarity on that yesterday?
Yeah, not much. We do know that Michael Barr was really brought to the surface of all of these problems in February, so potentially that is when, as well, Fed Chair Jay Powell also was aware. When it comes to the Fed Chair, Jonathan, we should note that Barr was pretty honest yesterday and also saying that they would be a little bit more welcoming and open, as the Fed Chair said as well, to an outside investigation. This is something that a number of lawmakers have called. Why should the Fed be investigating themselves? Potentially we need to bring in an outside probe.
MH, great work as always. Looking forward to day two of the coverage and you leading it. Anne-Marie will lead the coverage through the day and then again at 5 p.m. Eastern time. Balance of power with Joe Matthew. Looking forward to that. Speaker McCarthy then, bit of tension between him and the president, bit of tension between him and Beijing as well. Bloomberg learning the White House National Security Advisor spoke with China's top diplomat just last week. The country now warning Taiwan's president against meeting with Speaker McCarthy during her trip to America, writing this: if she meets with McCarthy, it will be another provocation that severely violates the One China principle. We resolutely oppose this and will definitely take measures to respond. Emily Wilkins joins us now for more. Morning, Emily.
Good morning, Jonathan. Well, certainly some very interesting developments going on, both with National Security Advisor Jake Sullivan speaking with China's top diplomat. Clearly an effort here by the Biden administration to start bringing the temperature down again on the relationship between the two countries after tensions really got raised with some of those balloons that were floating overhead. And so this is the Biden administration's attempt to really get things back on track, to potentially set up a call between Biden and Chinese President Xi Jinping, and to sort of reestablish some of those connections between the two countries. Of course, right as this is happening, you have Taiwan's president coming on a 10-day trip to the U.S., where she is expected to meet with Speaker Kevin McCarthy in Los Angeles. Now, you've mentioned that that threat has sort of been issued, this warning that McCarthy should not take the meeting. But from what I have heard from Kevin McCarthy when it comes to Taiwan is that he is every bit as eager to be just as aggressive as his predecessor Nancy Pelosi was. I mean, certain concerns did not stop her from going to Taiwan. And at this point, it seems like McCarthy is just as eager to be just as aggressive, just as hawkish, and to have this meeting with Taiwan's president. Of course, we'll see what the next developments are here, but it's certainly something that McCarthy is eager to do, is to kind of put on that very aggressive, hawkish stance.
Emily, just quickly, consequences. This is what China had to say, the Chinese government. We will definitely take measures to respond. Do we know what they are?
We don't know at this point what they would be. I mean, certainly we can look to what happened after Pelosi had her trip to Taiwan with some of the increased military action in the area. But I think to a certain extent, this is all going to have to be a balance game. That Biden administration, they want to have that working relationship with Beijing. They want to keep the lines of communication open. But at the same point, being aggressive against the Chinese government, it's one of the few areas of bipartisanship and one that lawmakers are looking to.
Emily, thanks for that. Let's get back to the market. 23 minutes in, equities up by 1%. Katie has some sector price action. Hey, Katie.
Hey, John, all 11 sectors in the green right now, real estate leading the way. Healthcare, your relative underperformer, still up about 0.4%. I want to talk about chips, though, because you have the SOX index outperforming today, up 2%. Look at the year-to-date board, up 23% this year,
Wow.
24%. Not bad.
What a move, Katie. Thanks for that. Up next, your trading diary from New York. This is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
As always in this situation, there's one question. Will it stick? Decent day of gains on the cards right now. 25 minutes in, up by about 1% on the S&P and the Nasdaq, up by 1.4%. That's the price action. Let's get to the trading diary. Bank hearings continue on Capitol Hill, top of the hour. Then we get economic data from pending home sales on Thursday. US GDP, another round of jobless claims, plus more Fed speak. Kashkari, Barkin, Collins on deck, followed by Williams, Waller and Cook on Friday. And we close out the week with a UMich sentiment survey. I just wonder how important the incoming economic data is now, given the banking difficulties of the last couple of weeks. And I've mentioned this a few times, data dependent on what data? Is it a banking situation or CPI and payrolls, retail sales, and all of the above? We'll continue that tomorrow. From New York City, this was the countdown to the open. This is Bloomberg TV.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Our studios in New York and San Francisco, our new hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Could face bigger challenges. What's next?
Was going to keep rating World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make a decision.
This is Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today. And then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing. Existence at stake, right?
the pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech in right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while